Good morning. Welcome, everyone. It's my pleasure to welcome you to our joint FASB IASB Educational Board meeting today. We're privileged to have several members of the IASB board here with us today, and Andreas Barco, the chair of the IASB, and I will be chairing our meeting today. Before I get started, just a couple reminders for those in the room here in Norwalk. When you're going to speak, you will need to press your speaker button because it will direct once. Yes, only once, apparently. Thank you, Sue. Only once. And in London, those who are participating virtually, we also have a virtual queue for those in London, and we can see you on screen. So good afternoon, everyone there. And with that, Andreas, I would just like to say this is, I think, about the sixth joint meeting I've had, but I'd say you and I've had 5 together. Right. So a lot of expectations for today. I will say I know I found them very interesting, and I think our audience will find them very interesting today as well. We always benefit from sharing information that we see around the world, and there's certainly no borders on good answers to accounting issues. So.
Absolutely, and thank you very much for the opportunity to meet with you again. You're absolutely right. It's 6 times. The 6th one's being carried forward, and I'm very grateful that you actually let me meet with you again one final time. I think the agenda that we are going to go through today speaks for itself, and it's actually quite reassuring to see how many topics both boards are discussing that actually have touch points and relationships. And I think if there is any opportunity that we can bring our standards and sets of standards closer together, or keep at least the proximity where they are already aligned and very close, that will be absolutely great. And I'm very much looking forward to today's agenda.
Well, excellent. So with that, maybe we'll dive right in. I know it's a little later in the afternoon in London, so we have a fully packed agenda. The first topic on our agenda today will be business combinations and related topics. And with that, let me turn it over to Jill and our team here in Norwalk to begin the tee up.
Great.
Good morning, Jill.
Good morning. Thank you, Rich. Agenda Paper 33 summarizes feedback the FASB received on business combinations and asset acquisitions through several sections of the 2025 agenda consultation. Those sections included the interaction of consolidation guidance and other transactions, enhanced disclosures, the definition of a business, and push-down accounting. As context, the guidance on business combinations in Topic 805 and IFRS 3 is largely converged. Both use the acquisition method with fair value measurements at acquisition date. For asset acquisitions, we understand that the basic approach is also similar under both frameworks. That is, the acquirer allocates cost based on relative fair values, and no goodwill or bargain purchase gain is recognized. The area that generated the most feedback in the FASB's agenda consultation process was the accounting requirements for business combinations and asset acquisitions. Stakeholders, primarily practitioners and preparers, indicated that 1, the lack of detailed asset acquisition guidance, and 2, the differences between business combination accounting and asset acquisition accounting has resulted in diverse reporting outcomes for economically similar transactions. When the asset acquisition guidance is limited or incomplete, entities often analogize to other U.S. GAAP, including, in some cases, the business combinations guidance. Stakeholders have noted that this has resulted in diversity in practice. They also noted that the asset acquisitions have become more common since the FASB narrowed the definition of a business in 2017. This makes gaps in asset acquisition guidance and differences between that guidance and business combination guidance more significant in practice. Stakeholders also provided feedback on disclosures for business combinations. Investors requested additional information, such as pre-acquisition financial statements, valuation techniques and inputs, the effect of acquisitions on financial statement line items, and information about payout provisions and contingent consideration. We also noted a few references in the feedback to the IASB's project, and we are continuing to monitor developments in that project. Now I'll turn to the definition of a business. Most stakeholders indicated this area is a low priority because the current guidance is generally operable and there is no significant diversity in practice following the FASB's recent amendments in 2017 to narrow the definition of a business. Finally, I'll turn to push-down accounting. Most respondents to the agenda consultation characterize this area as a low priority. Unlike US GAAP, we understand that IFRS does not permit push-down accounting. Stakeholders generally said that US GAAP guidance on push-down accounting is working as intended. However, some noted US GAAP lacks implementation guidance on certain questions. A related concern raised by a couple of stakeholders is that the requirement to use the parent's basis in common control transactions is inconsistent with the optional nature of push-down accounting. The slides provide more detail on the current guidance and the feedback we've received, and we're happy to answer any questions. In closing, the FASB plans to discuss the business combination topic at an upcoming meeting.
Great. Thanks. Let me turn it over to Jen. Jen, thank you.
Thank you. Good morning. The 2025 Agenda Consultation ITC included discussion on Goodwill and a question for respondents, which is included in the materials for today's meeting. Approximately 31 stakeholders provided input on Goodwill in response to the 2025 Agenda Consultation ITC. Stakeholders generally provided mixed views on whether the board should address this area, and if so, how the board should address it. Stakeholders who did not support a project generally noted that the current accounting for the subsequent measurement of goodwill is operating as intended and is widely understood. Other respondents further noted that the board may experience the same challenges in deliberating this topic as it did during the project on goodwill that was removed from the technical agenda in June 2022. The ITC respondents who supported a project generally noted that the subsequent measurement of goodwill is complex and costly to apply and provided a variety of different solutions to address these challenges. Stakeholders provided various potential paths forward if the board were to pursue a project on goodwill. Broadly, the suggested path fall into one of the following categories. 1. Reconsider recognition requirements for goodwill. 2. Require goodwill to be amortized after initial recognition. 3. Consider targeted improvements to simplify the impairment model. 4. Enhance disclosures. The board discussed feedback received in response to the 2025 ITC on February 4th this year. The board directed the staff to perform additional research with the objective of simplifying the subsequent accounting for goodwill by requiring impairment testing only upon a triggering event and allowing goodwill to be tested for impairment at the operating segment level. The additional research will be discussed with the board at a later date.
Great. Thanks, Jennifer. Let me turn it over to Akshaya. Good morning, Akshaya, or good afternoon.
Thank you, Rich. Good morning, good afternoon, everyone. As you might recall from the last joint meeting, the exposure draft business combinations disclosures, goodwill and impairment, published in March 2024, proposed amendments to IFRS 3 business combinations, in particular, to improve the information companies disclose about the performance and expected synergies of business combinations, and IAS 36 impairment of assets, in particular, amendments to the impairment test of cash-generating units containing goodwill. Feedback from users confirmed the information is useful, and many preparers acknowledged users' need for information and accommodations made by the IASB to mitigate preparers' concerns. However, preparers continued to disagree with requiring the information in financial statements. Other concerns expressed by stakeholders included auditability-related concerns, commercial sensitivity, and litigation risk for forward-looking information and monetary costs. The IASB discussed our initial analysis on most aspects of the feedback and made tentative decisions on some aspects at meetings between February 2025 and April 2026. In May 2026, we presented a suggested package to the IASB for disclosure of performance and expected synergy information, which is a significant part of the proposals. At this meeting, we asked the IASB if the benefits of the suggested package justify the costs. The IASB tentatively decided that the benefits of the suggested package of performance and expected synergy information would justify costs. 7 of 13 IASB members agreed with this decision. Although a narrow majority of IASB members tentatively agreed that the benefits of the suggested package of performance and expected synergy information would justify the expected costs, other board members disagreed and had concerns about the package. The IASB will consider at a future meeting whether further revisions to the package could be made to resolve these concerns. The IASB still expects to make a decision on the project direction in the second half of 2026. And with that, I pass back to you for any comments or questions.
Great. Thanks, Akshaya. Just as a reminder, if you're in the room, if you want to get in the queue, just put your name tag up and Nellie will keep close track of that for me. And in London, we have them raising virtual hands, correct? Okay. Andreas, my guess is that 6 years from now, if you and I tune into a joint education session, there will be a discussion of business combinations and goodwill of some form or other. By the way, thanks very much for the update. I was just curious, your most recent board meeting, you have maybe a majority support, but not the super majority that you use. And it's hard sometimes when people dissent as to group it all together, but was it generally because it didn't go far enough or it went too far? I was just curious.
So I'll give you my take, and I'm happy for board members to obviously join in and provide their views. I think Zach in the board meeting put it very nicely. He said, if you look into the individual decisions that were taken over the course of the last year, they all made sense. They responded to concerns that we have heard from stakeholders, and the suggested solution that the staff presented seemed appropriate. However, when you put everything together, there were two overarching concerns. The first concern was the population that would be required to actually present post-acquisition performance numbers. So there were anecdotal evidence presented during the meeting that in some cases, investors may only see that information every 15th year. And so the question was, okay, what's really in for us? The second overarching concern was that even if that population would apply those requirements, given the exemption that was provided to the package, it may be that there is a scope out from providing that post-acquisition performance, or at least part of that. So, and that actually gave rise to concerns by people and saying, we are not really seeing that much of an improvement, yet we have everybody go through the changes. So the cost will be there, but whether there is a benefit seems to be doubtful. And that was the key takeaway that I took. So, but I'm happy for other board members to just join me in that.
Okay. Zach, I think you were called out, so let me start.
Yeah. So I'm going to agree with Andreas's comments about what I said. Just to throw some further support in there. There's a third thing I would add, though, which is, one of the difficult things we had at the beginning of the project in framing how these disclosures would work is thinking about whether you dictate what every acquirer should present if they fall within this subset, or whether you do what we did, which is say, let's take a management approach. And management should describe why they did the acquisition. What were the reasons? What were their objectives? What were their targets they were trying to get to? And one of the last sort of concessions we made around auditability was we would limit the universe of the key objectives and targets and subsequent performance to only those that were related to currency amounts. And that took a reframing to say, well, am I really seeing the whole picture of why management did the acquisition if we're taking a management approach? And so I think that was the third domino that really pushed me. I was one of the dissenters, or those who said the costs exceeded the benefits at this point, pushed me over into that camp as well.
Bruce?
Thanks. Just to echo some of the comments. I mean, I think to me, as also one of the people who wasn't so pro where the project's got to, is besides the points that have been made, it kind of got to a point where we never had anybody championing us to do this. I mean, we got to a stage where the preparers were very unhappy with where we were going, and they weren't happy with the issues of commercial sensitivity, what was going to get given. The investors were saying that we diluted from the original proposal to a point where they didn't see there's a lot of value. The auditors were unhappy with the auditability of it. It also gets to a point where you've kind of got to ask who you're doing this for. And when all your stakeholders, and especially given this project is a very polarized preparer investor type project, which it always was going to be. But when both of those parties seem to be unhappy with a lot of the outcome, you kind of start saying, what's the point in doing this? Because we're just going to increase cost in the system with very little return. I think that becomes quite a big challenge. The other thing I was going to point out, just building on what Zach had said, I mean, to me, the currency units was, my concern became we're not giving people the full picture. And I actually think we've got to a point where now the proposals are misleading. I mean, just an example, if there are 5 reasons you bought a business and only one of them relates to currency units, we're leaving 4 of those out. But what does that say to an investor? And the other thing that concerned me was when you start reducing the disclosures within the financial statements, the big concern to me becomes, well, if you're a preparer and you're saying, well, that's what's being required within the financials, well, I'm giving a whole lot more that's in the narrative. Well, I'm going to stop giving in the narrative because clearly I'm not needed to give it. And the worry to me is that you're actually going to start seeing the narrative, the management report stuff the quality of what's in there starting to reduce, because we're requiring so much less within the financials. So I just think the worry is that I think as we start progressing, I'm not convinced we're going to get to a situation where we're going to get better financial reporting.
Rika?
I just want to give a different picture of this discussion, because when we started this project, what we are looking at is probably 2 aspects of business combinations accounted for under IFRS 3. And one is probably the information around acquisition itself. And another thing is subsequent performance of acquired businesses, especially when the company's management decided to integrate the businesses between acquired business and existing business. And then when looking at our standards and also looking at information outside financial statement, of course, there are a lot of information around business acquisition, upfront acquisition date. And also at the acquisition date, we have a lot of disclosure requirement around acquired businesses and how to account for those transactions in accordance with IFRS 3. But what we're missing inside and outside financial statement is about subsequent performance of acquired businesses or integrated businesses. So because of that, our project focus not just only on the information at the acquisition date, but also requiring management to provide a subsequent performance of acquired businesses. So that area is simply, a gap of information, even within and outside financial statement. So I think the benefit of projects to exist, and then even though there are different concerns around disclosing the more information around the acquisitions and subsequent performance, but still, I think there are benefits outweigh the cost when thinking about filling that gap within the financial statements.
Thank you, Rika. I have Fred and then Hillary.
Thanks. I just wanted to follow up with Bruce on the currency issue. So when I think about what you're talking about so what would have remained would be something like revenue growth or expense reduction. But what wouldn't be available would be a lot of other things, such as market share gains and those type of things. And was there concern that I guess what was the argument for moving to currency only, I guess, and how limiting did you feel that was? Maybe you could just expand a little bit more on that issue.
Sure, be happy to explain. So to me, some of the moves to that was driven by the concerns from the auditors around the auditability of the kind of non-currency user metrics. So things that could be linked to greenhouse gas emissions. It could be linked to anything outside of that. And to address some of those concerns, we had to start limiting it. And I do feel that that was the limitation, because whereas I appreciate there is generally going to be a currency kind of link to what you are tying into, it's not the only reason you may do something. And I think that, but when that's the only thing you're focusing on the financial statements, my worry is, what if I genuinely bought another business? Because let's assume I'm in a country, take Europe, where there's a big drive towards green energy. And I'm doing the transaction purely because this gives me access to green credits, even green energy, green technologies that I may not have. Now you've got to do these tenuous links. Now you've got to start to build these links in. I'm worried that at some point we're going to have to answer the question of, so how do we do all of that? Does that mean I need to monetize every synergy that I have out there, every reason I bought it? And I just think we start getting into those questions, it's going to get too much. So I just felt it was too limiting in terms of saying to people, we're going to tell you what's important to put in the financial statements. And that went a little bit, to my mind, against the management approach that we were taking.
Hillary?
And I appreciate this discussion because I know we've heard, right, it sounds like we have very similar feedback with regards to investors wanting to better understand the performance or looking at the future performance of a business combination, or being able to kind of match that up with the expectations that were expected when you did the business combination. And certainly we've kind of heard, why don't you guys take a look at what the IASB is doing with regards to that? Curious, right? We haven't gone down that path yet from a disclosure perspective. We've been looking at more, can we make certain changes to the Goodwill impairment model to make it more cost beneficial? I think there are some of us who maybe don't necessarily believe that those smaller tweaks are going to change that cost benefit equation, but very much interested in the staff perspective on that, and they're going to come back. But my question is, if the disclosures, and I know you haven't fully decided what you're doing with regards to BCDGI, but a question I just had was, do you think that, are you still getting feedback that there are other things that are to be done from a Goodwill impairment perspective if those disclosures don't go through? Or is this more of, if we can't do this at this time, it may come back later? Just curious if there's kind of a follow-on impact for other standard setting as well.
I'm happy to give it a start, and then Javed, please feel free to join me. We still have a track in the project that deals with IAS 36, and the board hasn't made final decisions on that one, so that still stays there. So when Akshaya said the board is still on track to make a decision as to the project direction in the second half, it could vary. It could mean that let's find ways to actually accommodate the concerns of board members with regard to the cost benefit of the disclosure package. It could be to say, put that to rest and let's just deal with the IAS 36 improvements that we could do. But I don't think that there's any appetite at this moment to actually reopen the debate. Let's go back to amortization model or something like that. So I think that would be fair to say.
Yeah. So I threw myself in the queue here because I did have a question. Probably one of the most interesting aspects of your project and where you made some decisions was the bounds of the financial statements. And I'm kind of curious, as you've gotten to this point, you made certain decisions there. We benefit here in the US that we have a pretty bright line definition between the financials and outside the financials. And part of that's due to regulatory issues and legal issues, right? There's no safe harbor in the financial statements, whereas there can be some litigation safe harbor. Ultimately, how did you address that? And do you feel you've addressed that so you can deal with that on a going forward basis? In other words, the bounds of the financials and related potential litigation that you'd be exposing, say, a IFRS registrant who decides they'll file in the US. I'm just curious, because that's something we'll have to deal with on a go forward basis as we continue to challenge that.
So I think that question came up obviously internally, and the board, I think, was convinced with the staff's rationale that this type of information can be housed and can be required in the financial statements, because a transaction has happened, and this is a matter of fact. So therefore, yes, there is forward-looking information stemming out of that particular transaction, but that is no different to other transactions and events that have happened. If you think about any impairment consideration going forward, that's forward-looking information, but it relates to something that has happened in the past. So the rationale of the board was really similar, is that you agree to do an acquisition, and once you close that, that is the matter of time that you actually hit the financial statements, and everything else is just a consequence of that. Now, it's fair to say that not all stakeholders agree with that, right? And we have heard numerous parties, I would say predominantly from the North American continent, but not only, plus securities regulators that have raised concerns and that shouldn't be information that should be housed in there. It should go somewhere else. There are parties that point at management discussion and analysis that obviously is beyond our remit, similar to yours. Yes, we do have a practice statement on management commentary, but it's a voluntary guidance document. So things pop up there as well. And you alluded to safe harbor provisions. Now, the majority of jurisdictions around the planet don't even have safe harbor that's pertaining to management commentary. So I think there is the question then on uneven level playing field or unlevel playing field.
Yeah. And I guess the carry-on issue there too was information that's outside the company's internal control environment. And listening to Bruce's comments, I got the impression that might have been one of the determining factors to pull certain items out of where your proposal stands today. Is that correct? Okay. Thank you. Linda.
Thanks, Rich. So I just wanted to give a little perspective about this project because I've pretty much been involved in it in one way, shape, or form since the beginning. And I'd like to echo Andreas's comment that I certainly hope we're not going back to talk about amortization again. But I can tell you as recently as 2 weeks ago, I got a question in that when I was out doing outreach in the field in terms of whether we would consider that in terms of this project before we finalize it. So it's an ongoing theme. I think the interesting thing about this project is this is an area, speaking as a former preparer, this is an area which senior management probably fights the hardest to make sure they can frame the disclosures about the performance of an acquisition in the best light they can, because this is where they're being held accountable at the very highest levels. You know, the CEO and his or her direct reports and that sort of thing. And I always found sitting in my management position as the senior accountant, the notion that these were the things where I'd have to work with them the hardest. They always avoided an impairment because they didn't want to admit the acquisition hadn't been successful. They were always trying to frame the disclosures on the good things as opposed to things that they found out after they actually acquired the thing and said, "Oh, I didn't know this before I did the acquisition," you know, that sort of thing. So management knows why they did the acquisition, but they're also trying to frame it in the best light in terms of the overall impact on the company's performance going forward. So if we're having a difficult time coming up with kind of the right spot for these potential disclosures, we shouldn't be surprised about that because we're dealing with so many jurisdictions with so many different regulatory environments. It's just the way it is. And so, you know, we've made a lot of efforts in the last few months. We've talked to some very senior folks at the audit firms to ask them, you know, is there a way forward on this project? How can we alleviate some of your concerns? And interestingly enough, with some of our board members doing some outreach, even last week, we heard from securities regulators saying there is value to this project. So if you could find a way to at least nudge the disclosures forward, we would appreciate that. And I think we were a little bit, I think at the time, surprised to hear that. My board members were telling me about it yesterday. So it is an interesting project. It has a history. And I think in some way, shape, or form, you know, while we can probably still help with the IAS 36 issues, how we land on the disclosures and stuff is still a bit out for grabs as the staff is wrestling with what they can do to alleviate some of the concerns around cost benefit. And at the end of the day, one of the things we'll have to stand back and figure out is, can we move financial reporting forward? Even if it's not where we want it to be, can we at least move it forward? So certainly that's what's on my mind as a board member who is thinking about the next time the staff will come back and talk to us, and we'll see where they land.
Great. Thanks, Linda. To do?
Thank you, Rich. Thank the team for the tee up, the papers. It's a quite interesting project because actually, and as Linda referred to, and I couldn't actually control myself to refer to some stakeholders asking for the reintroduction of the amortization of goodwill. But most interesting, those that are against it said that we can't reintroduce the amortization of goodwill because of the convergence with the IFRS. And then when we decided about not reintroducing the amortization of goodwill, one of the arguments was exactly the convergence with US GAAP. And then now we can see the opposite direction. But anyway, I just actually don't want to come back. I think we have made the decision and we just should move on. But I found quite interesting because we have two aspects in relation to the feedback provided to your invitation to comment. One aspect for me very clear, especially from preparers, they are still complaining about the cost of dealing with the impairment of goodwill. And I think that Linda referred to that one. I think that we have made very good progress in relation to the amendments to IAS 36. And then we can say that this, in my view at least, is a big victory for this project, what we have already done. In relation to the second part, that's exactly the investors' feedback, getting more information in relation to the subsequent performance of the acquired business. It's a perfect comment. It's good that Andreas referred to the comment from Zach. If we look at the individual recommendations, it sounds logical. If you think about what we are trying to do here is to improve the information about the subsequent performance of the business, also sounds simple. But how to get there, that's the most complicated one. And I saw some of the recommendations that came from your stakeholders to your invitation to comment. For example, fair value measurement inputs and valuation, and pre-acquisition financial statements of the acquiree, effect of combination. It sounds very simple things to do. Still need to hear from preparers whether it is or not. But one thing that drew my attention is revenue from the acquired entity in the first year post-acquisition. And one thing that maybe made our proposal a bit more complicated, because we heard that from users, that providing subsequent performance without the context of the acquisition is not a complete information. That's why we have the key OTs. But I saw some of the enhanced disclosures proposed by stakeholders in your invitation to comment. Very interesting and maybe easier to achieve than what we have started in our proposal. I think that this is something very, in my view, worth exploring and maybe simpler, and then can at least improve reasonably the level of information to investors without adding cost or reasonable cost with reasonable cost to preparers. Thank you.
Great. Thanks, Tadeu. Nick?
Thanks, Rich. Very interesting topic. And I wanted to respond in part to the question that Hilary posed a moment ago. Is there anything else we could do? And to some extent, Tadeu has already touched upon that, I think. But I was struck in terms of the presentation from Jill on page 6 about pre-acquisition information about the acquiree. I think today, although we have a requirement for pro forma information in the first year of acquisition, both profit and operating, profit and revenue, there is a frustration amongst users that information is impacted by the purchase price allocation exercise, and they can't get to the numbers that they want to get to. What have you actually acquired on a historic basis? And you've partly dealt with that, I think, through what you've done with deferred revenue, and that you're now picking up more of the historic trend rather than having that distortion in the first year. But again, I think that's a less controversial. It feels like it's a lower cost thing that we could do. Given where we are in the lifespan of this project, I think it's a question whether we could actually do it in this project. I doubt it. But I think those are the type of things where there probably are still some wins.
Thanks, Nick. I would say that we generally have gotten pretty favorable feedback from investors on that change. We didn't go as far as inventory, for example, but at least on the revenue change, we did get some favorable feedback, and I'm sure this will be part of our board's discussion on BizCom in general when it comes back from our staff as part of agenda outreach. Next, I have up Bruce again. Bruce.
Thanks. I just want to come back on the one paper, a slightly different take on the Goodwill. I mean, I kind of read with dismay that you guys had somebody raise it again. I mean, for those on our board who are around for our discussions, we spent ages talking about this. And, you know, to me, Goodwill is what I believe is like a religion to people. If you're an amortization person, you're not going to change your view. And if you're on impairment, you're not going to change your view. And it's going to take a lot to get there. But I mean, it was interesting reading some of the feedback around some of the proposals because I mean, these are obviously the same type of things at the end of the day. And we went through quite a detailed exercise and looking at the advantage of one to the other. I guess I was just interested in I see you put some minor things that you've asked the staff to go back to. But I mean, the thing I was interested in finding out from you guys is, do you think you would seriously consider the amortization question again? I mean, do you think that that's something that's going to genuinely come back to discuss? And the second one, just by the way, which I always like, is the option of expensing in year one. I always think you can explain it away. I think investors understand it. And you're not 20 years down the line still trying to explain a balance that nobody remembers how it was calculated. Let's see, I've solicited some concerns there.
At the risk of recreating our board meeting, we did discuss both of those issues, and there was not a majority of our board interested in pursuing either of those issues. That being said, the nature of our agenda consultation, which was as simple as asking the question of what should we be working on, prompts responses. And my guess is if we issue one, and I wasn't really joking, in 6 years from now, we will hear Goodwill. And part of our process is, and part of our bargain with our stakeholders is they tell us what they think, and we actually bring it back in front of our board in a public meeting and talk about each of the issues. So if somebody, a few years from now, as part of an agenda outreach, again says it should be Goodwill, we'll talk about it again. And who knows, maybe something has changed. I don't know. It seems like it just, we hear very similar things over time. The two things the board was interested in looking at is really about cost. And is there a way to reduce some of the costs without reducing the relevance of the outcome, the accounting outcome? We have reporting units that are only maintained solely for Goodwill impairment purposes. And the question was, would there really be a significant change in either cost or outcome by changing that level? And our staff will come back with that report to us. The indicator of impairment versus annual test really comes back, you already have to do when there's an indicator of impairment. Is there a incremental cost to the annual test? Is there an incremental benefit to the annual test? If you have to do it recurring, does that help? Or is there such, and I think what our staff will hear on that one is about the rigor around projected financial information that's built in the US regulatory environment, even when there's a lot of headroom. And does that need to be there? And so part of it will really be unique to the I would say more the audit and the regulatory framework around it or not. But again, our board, it'll come in front of the board, and if the board's interested, we'll pursue it. Otherwise, I think that's really the last topic we have that's Goodwill, related. So let me go to Bob. Bob?
Yeah. Great. Thank you, Rich. I just wanted to come back on 2 points. One, Rich, you raised on the boundaries of the financial statements, and the other that Hillary raised that seems to be the one that we're talking about right now. So on Goodwill, I just had a meeting with some security regulators, and the message from them is, are we in this area of Goodwill getting all the decision useful information, giving all the decision useful information that users need, because it's such a large asset for many companies, and impairments are always going to be a laggard, and so there was a bit of a push there, and something you might want to consider of taking a look, and they were encouraging us, the board, IASB, to take a look at whether there is more information that we could provide, particularly around the judgments in the impairment analysis, and some sensitivity, and how much cushion there is. On the issue of the business combination disclosures and the boundaries of the financial statements, I think it's a really great question. It's something that I've been concerned about for a while. on this project and saying how this disclosures really need to relate to elements of the financial statements or information about those elements. And I'm fully supportive of providing the subsequent performance of business acquisition. And we've heard that from users. They want that information, but it still, in my mind, has to be within the boundaries. And so Bruce talked about, if you acquired because you want to reduce greenhouse gases, well, that's great. And I think, yes, that should be disclosed, but is that supposed to be disclosed in the financial statements, or is that should be disclosed in management commentary or sustainability report? I think, it doesn't really relate necessarily to an asset or a liability, income or expense. And so I recognize the late change that we've made, to make these related to currency units. I think that goes a long way to helping for the boundary. But I'm still concerned about the targets. Targets are desired outcomes. They're not even assumptions. They're forward-looking information, but they're not even assumptions into assets and liabilities. I understand the argument that was put forth in our basis for conclusion that it relates to somehow to the price that was negotiated, but it wasn't actually setting the price. It's a consideration of that price, but it doesn't actually set that price. That's a negotiation. And so that's why I've been concerned about having, some of this information in the financial statements, as I'm struggling with how it belongs within the boundaries. So I'll leave it at that.
Thanks, Bob. Christine?
I think when I look over the history of the last 15 years of standard setting around goodwill and business combinations, the focus has been very much on reducing cost. In 2011, we issued the standard to introduce step 0. We put in the private company alternative for amortization. We eliminated step 2. Our current research project, again, is about reducing cost. And I think that from an investor perspective, really the only signal that they get these days regarding subsequent performance is impairment. But all of those efforts have just made that impairment more and more a blunt instrument, which puts increasing pressure on their need for useful information regarding subsequent performance. I mean, even when we were working on our amortization project, it was from a cost reduction lens, not from the lens of how can we use amortization to provide more useful information about the success or failure of the investment that was made in the business combination. And I think at some point, as standard setters, we're going to have to recognize that it doesn't matter what model we choose accounting for goodwill and goodwill and business combinations. If we want that accounting model to provide useful information to investors through amortization or through impairment or through disclosure, some combination thereof, it is going to be costly. And I think that this constant focus on cost reduction is just really got to the point where it is working at cross purposes with the objective of financial reporting, which is to provide useful information. So I guess I would just close by saying, I really commend the IASB for trying to finally take on a project which was motivated by providing more useful information. I completely understand the difficulties that you're all experiencing. But if we stay on this cost reduction path for much longer, I think it is just going to make it that much more critical for investors that we figure out a solution to this problem.
Okay. Thanks, Christine. Bertrand.
Thank you, Rich. It's good that I'm following Christine. I wanted to speak to echo what Linda said earlier, i.e., in regard to the next steps. And I think the issue of the project, of our project, at least the way I see it as a former preparer, has never been cost reduction, especially on the IAS 36 requirements. Effectively, we will have to assess when the staff will come back to us in July, whether the benefits of whatever package, even as little as it could be, exceeds the related costs. And to me, there are two ways of looking at it. It's in contrast to the current IFRS 3 and IAS 36 requirements, depending of whether we talk about subsequent performance of an acquisition or impairment test, and also versus the current practice that is evidenced by what is put in the financial statements or in the external financial communication by companies. The second comment I would like to make is because it has been alluded to but not said crystal clearly in the discussion. I think when we consider the exemption on the subsequent performance of an acquisition and the synergies, it was a form of legal protection for companies, their management and their auditors, because we were considering that we could request those information in the financial statements. And when you request information that are touching the boundaries of forward-looking information, of commercial sensitive information, generally that those entail potential, let's say, significant potential litigation risks. And so therefore, you need to get some form of protection, of legal protection. So the exemption was certainly not the most perfect tool. It was not an absolute protection, but at least it was an alleviation of some of the concerns we heard by auditors and above all preparers in that regard. Thank you.
Thanks, Bertrand. Sue?
Thanks, Rich. And these are such interesting topics to me because to your point, Bruce, they're somewhat never ending and they're totally intertwined. And as it relates to the amortization of goodwill, I feel like we will continue to get the question because of the alternative that we have for private companies and how successful it has been for that population of stakeholders. But yet at the same time, I feel like we feel a little constrained, at least myself personally, because of the mixed feedback that we've gotten from investors on how they use goodwill. And so I watched with a lot of interest the project that you all had because I thought, oh, maybe there's a nugget there that we might be able to leverage off of, which would then in turn take the pressure off of goodwill and allow us to very easily make a decision to amortize goodwill. But, you know, so far, not as easy as it looks. But I do think at times we, you know, when I think about even some of the other topics in this area, right, when we made a previous board made decisions about the definition of a business and narrowing that, well then, okay, we have less business combinations. It puts more pressure on differences between business combinations and asset acquisitions. And so it just underscores the intertwinedness, if you will, if that's a word, of all of these topics. But at least from my perspective, I do think that we are going to continue to get the question on goodwill amortization, just simply because of how successful it has been in that private company space. And you know, I take Linda's point. I hope that you're able to find a way to move forward on your disclosure so that, you know, at least there's some incremental benefit that maybe, you know, it's at least a step. So.
Okay. Thanks, Sue. Rika.
Sorry, I get used to it. Click twice.
There's no comment. Doesn't set up.
Okay. Yeah. That's good to know. Thank you. Yes. So we understand the boundary of information discussion, and we understood the limit of financial statement. So, but we are thinking about how we can fill the gap of information as a kind of the interim solution or stepping stone to think about, yes, we understood that because of the definition of businesses, that means we narrow the scope of the information consequently. But at the same time, without starting something to giving the investors kind of the anchor for the information they can find as an anchor to facilitate the discussion with management and investors, we cannot move any needle at all. So I think that is a reason I still think there is a benefit of this project to explore the enhancing the disclosures. And then about the I-36 improvement, we usually enhance emphasizes about the reduction of the cost a lot again and again. But the aims of this project, how to amend I-36, is more about lifting and reducing the subjectivity, unnecessary kind of the judgment around the impairment test. So as a consequence, cost must be reduced. But what we focus on is more like try to remove the unnecessary subjectivity around the impairment test that would help companies. And at the same time, because of the removing such subjectivities, we believe that the management can have a more efficient conversation with investors about the outcome of the impairment test. So that is kind of the target we are heading toward.
Thanks, Rika. Andreas.
So I'm surprised. I just want to come back on something that I found interesting in that discussion that Bob alluded to in having conversations with securities regulators. There still seems to be a different understanding as to what these disclosures are meant to portray, because the disclosures that the securities regulators were talking about were better disclosures around the impairment test and the impairment of goodwill, which I thought was not the primary objective that we had. Our primary objective, to put it quite bluntly, is there's a ton of information about impairment testing and goodwill in the financial statements that most investors are saying, well, this is all related to the past. It's an accounting gimmick. It doesn't tell me anything about the core question. You put money on the table. Was it worth it or not? It's a very simple question. I don't see anything that. And that is why we said the objective of our disclosures is really to give better information to investors about post-acquisition performance. Right? Tell me something about that bit that is the missing link. Doesn't mean that we would not look into additional disclosures about the impairment test, but that wasn't our key driver. And I think the closer we work towards those questions, back to tell me something about how you did the impairment test, I think that will put pressure on the question of, well, can we not really go back to an amortization model and things like that? So I'm absolutely with you. I think that question probably will never go away. I sometimes actually smile if I look into the accounting prescribed in my own country under national GAAP. We do have an amortization approach. They say there is a presumption that you amortize over 15 years, but people seem to be forgetting that there's also a general requirement to do an impairment testing. So, practice tells us people just keep amortizing over 15 years and then they never really track, actually, is that sufficient, or should you have impaired the goodwill balance much, much earlier, so that the ongoing amortization charge should actually be less of that. The other bit that I found interesting in your deck is the suggestion by some to give an accounting policy choice between an impairment test and an amortization model. Now, in a different project, we just made an exceptional decision to actually introduce an accounting policy choice, and that was in the equity method and downstream transactions between an investor and its associate. But I think we said there we would only provide that option if there were disclosures that allow an investor to go from method A to method B and vice versa. If I applied that same notion to the suggestion of your stakeholders, I think there is an inherent problem, because you could probably provide the necessary disclosures one way. So if you're doing an impairment test, you probably could do something like what would have been the quasi balance if I did an amortization approach. But if you did an amortization approach, I can't see how you would give the alternative disclosures had you applied the impairment test. So that doesn't seem to be working. And the question is, how do you then get the information over to investors that would allow them to reconcile company A and B's accounting?
You probably articulated some of the reasons why our board didn't have that. So I think if you talk to the board, Bruce?
Yeah, I was just quickly going to come back because Andreas reminded me of a point. I mean, Sue, to your comment about the nugget, I was sitting waiting for it the whole way. I mean, I'm a Goodwill guy. I'm not an impairment person. And I sat all the way going, at some point, the penny will drop with everybody else and we'll all go to Goodwill, to amortization. The problem is it never happened. But yet the reason I supported the direction the staff was taking and the board took was because I literally felt we were choosing between two evils. Neither of them are perfect. Neither of them actually give you the right answer. In fact, so you're dealing with two imperfect systems. And what really got me over the edge was to move people from impairment to amortization. I mean, just start thinking about how much work that's going to be for companies. How do you do it? Do you do it at a point? Do you retrospective? All the questions and work that brought up from moving from one perfect system to another meant that I just don't think we could justify making companies do that. So as much as I still would prefer to have gone the other one, it was kind of like the change couldn't be justified.
Well, not seeing anyone else in the queue, I think if our staff is keeping a draft of next year's agenda, we could probably put BizCom and related topics on it today. Just an observation on your project. There's a saying in the U.S., preaching to the choir, right? And I think we all have experiences of projects that are added and take lots of different directions, and there's a lot of changes in them, whether it's multiple exposure drafts, whether it's renaming the project, whether it's changing the direction of it, it's dealing with costs, dealing with investor preferences as you work through it. But then we're also all challenged at the very end that while the journey is interesting, and we're going to get into PIR and how important that is, the only thing that actually affects financial accounting and reporting is the final standard. And sometimes, I do think it's sometimes underestimated at the challenge for a standard setter to make sure that it's not a sunk cost approach, as we would say. It's more along the lines of what's the final standard and do you have it? So we certainly understand where you are. You've invested a lot of time, a lot of effort, and some tough decisions. So we'll watch them eagerly. And that's probably a good transition to our next topic, Andreas, which talks about looking at the standard setting process on a particular project.
Absolutely. Thank you, Rich. So the next item that we have on our agenda is the post-implementation review on leases. I think that the two previous joint education meetings that we have had, we have already updated each of our boards about where we are. So we are now coming to almost the conclusion of our side of the post-implementation review. So can I hand it over to you, Raf, to give us your presentation?
Thank you, Andreas. Good morning, everyone. Good afternoon, everyone. I hope you can hear me okay.
We can, thank you.
Good. So the purpose of this session is to provide you with an update on what happened in our project since the last joint meeting in October last year. The comment period on the request for information on the PIR of IFRS 16 ended on 15th of October last year. The board discussed the feedback summaries and the updated review of academic literature at its meetings in January and February this year. Some of the key messages in the feedback were that most stakeholders provided overall positive feedback. They said IFRS 16 is meeting or largely meeting its objective and its core principles are clear. Most of those who commented on the improvements to the usefulness of information about leases agreed that they are largely as the board expected. However, most stakeholders also raised a wide range of concerns about the usefulness of information in the most judgmental areas, such as lease terms and discount rates determination. Also, many of those who commented on the overall ongoing costs of applying IFRS 16 said that they are higher than expected. Among stakeholders who commented on lessees' lease-related cash flows, many said the improvements to the usefulness of information are largely as the board expected, and many others either explicitly said that they are lower than expected or provided mixed feedback. Many stakeholders also commented on application of the requirements in IFRS 16 with other standards, such as for financial instruments or revenue recognition, generally asking for clarifications to the requirements or additional guidance. At its meeting in March 2026, the board started deliberating feedback and began deciding on how to respond to that feedback. There were 6 questions in the consultation document. At the March meeting, we discussed 2 of the 6 questions. They related to ongoing costs of applying the measurement requirements and the usefulness of information resulting from lessee's application of judgment. At the April meeting, we discussed another question related to the usefulness of information about lessee's lease-related cash flows. So in March, the board tentatively decided to explore in a future research project the feasibility of cost reduction measures relating to remeasurements of the lease liability and discount rates. And this is mainly because stakeholders identified these 2 areas as the major cost drivers. In relation to remeasurements, the board decided to explore, for example, reducing the frequency of remeasurements and simplifying the requirements for variable lease payments that are linked to an index or rate. In relation to discount rates, the board decided to explore, for example, permitting or requiring lessees to use a simplified discount rate instead of incremental borrowing rate, and to use an unchanged discount rate for some remeasurements. Regarding the usefulness of information resulting from lessee's application of judgment, overall, it wasn't clear what the root cause of stakeholders' concerns was. One possible solution that the board discussed was to require lessees to explicitly disclose the judgments that they make when determining lease terms and discount rates. However, in the staff paper, we acknowledged that even if this information was specifically required, there still could be some questions about how useful the disclosed information would be. This is because, for example, entities with large lease portfolios would likely provide aggregated information. Also, it is questionable whether there would be any incremental benefits from requiring specific information about judgments in relation to what is already required in other IFRS accounting standards. Therefore, the board decided not to explore this matter further, and the board also decided to take no action for other matters or suggestions, considering their pervasiveness, potential costs, and benefits to users. At the April meeting, the board deliberated feedback related to the usefulness of information about lessee's lease-related cash flows. At that meeting, the board decided to explore requiring lessees to disclose the components of the total cash outflow for leases, together with the line item in the statement of cash flows in which each component is presented. The board decided to explore this to help users locate all the cash flow related information, given users' concerns about the fragmentation of cash flows. This matter will be explored within the ongoing project on the statement of cash flows and related matters. And the IASB also decided not to take action in response to other cash flow related matters. We will discuss the remaining questions with the board at its future meetings, and we expect to finalize this PIR in the final quarter of this year. Similarly to the FASB's process, the project will conclude with the publication of the project summary and feedback statement summarizing the matters identified, any actions the board plans to take as a result of the post-implementation review, and the rationale for the board's conclusions. Thank you.
Thank you, Raf. Before I turn it to you, Rich, probably just to say, in the previous slot, Bruce used the term religious views, and I think in lease accounting, we have heard religious views as well. So some of our feedback actually said you should have never moved to an IFRS 16 model. You should have stayed with the IAS 17 model. And that was quite pronounced in some of the jurisdictions where actually people said to this very date, companies are still providing alternative performance measures around IAS 17, so reinstating the old model. I think what I also found quite interesting is that what we heard in terms of unexpectedly high ongoing costs is something that you have heard as well. And I think that obviously is something where it calls for action, at least for some better understanding as to what is causing this. And is there a way to take unnecessary cost out of the system without completely diluting the benefits that investors are basically seeing in these new disclosures? With these points, can I hand it to you, Rich?
Yeah, no, thank you. We're not that different in a lot of ways, and some of the feedback. What I thought was interesting, and I'm reading into the comments, I'm assuming you heard the same thing. I think it's fair we underestimated the costs, and probably, in my view, the number one cost we underestimated was that for operating leases, we were taking something that was accounted for, I will call it off system, meaning it was pay as you go. And you didn't need to have anything about that lease in any system. You might have tracked it in a lease system, but you certainly didn't track it in your accounting system because it was close enough. And so it was just like vouchering any other executory contract. And that actually identifying it and pulling that into some kind of orderly accounting record and on an ongoing basis having it in an accounting record. There's the carry-on effects, right? There's the carry-on cost of, yes, if I have an amendment, I have to do these things. But that initial transition, and for those who didn't invest into it, who are trying to do it on the back of an envelope, those ongoing costs, those seem to be the most tremendous. And we hear it particularly in the private company space. But I'm curious, do you think you had a good handle on those costs either? Because I will admit, I think we missed them.
So I think what we heard, and Raf, please feel free to come in. I think what we have heard is people were acutely aware that they have to incur quite significant system change costs. And I think what we also heard is a view that ready-made systems weren't available soon enough to when the transition to the standard was necessary. So people actually, there are some companies that actually had to do true transitions, one probably on an Excel spreadsheet, and then the second one once the system was ready. But I think what we have also heard is most people said, okay, this is now sunk cost. That in itself would not be a reason to change the model, because people said, well, we've gone through one pain, don't make us go through another pain. So it's really the ongoing cost where actually those things that you now have inventorized are undergoing changes, right? And this is where changes to the discount rate come in, changes to cash flow, changes to assumptions. And I think that is where people said, do we really have to account for that for each and every bit? And does that really provide significant commensurate benefit to users? I think that's the bit that we fit.
Okay. But that's more the ongoing, but,
Yes, right.
But the original inventoriable and so on, what was probably more of an effort than we heard from stakeholders at the time of standard.
So what we've clearly heard is that people were surprised actually that of some leases that they have on a global basis. We've also heard the anecdotal comment that, well, this standard seems to be fine if you are the proud owner of 5 leases. But if you have hundreds and thousands and they sit somewhere on this planet, somewhere offline in some lease system or not even in a lease system, that's really where the surprise then came in. Absolutely. Christine.
I just wanted to get a little bit more detail on the feedback that you received from investors regarding the cash flows. So in paragraph 35 of the paper, it talked about the feedback that you received on the classification of lease-related cash flows by lessees, and also the lack of comparability between cash flows of lessees and those that borrow to buy assets. I just wondered if you could give me a little bit more understanding of what the specific request was for dealing with those 2 issues.
Raf, can I turn that to you?
Of course. I think in terms of classification, it's what Andreas said at the beginning, how stakeholders perceive, how users perceive leases, whether they are financing transactions or operating necessities or operating assets. And I think the feedback here is driven by whether it's debt or equity investor. It's one part of the feedback. The other part about the lack of comparability between those that borrow to buy assets and those that lease assets is about lack of sufficient information about non-cash movements, especially at the inception or lease commencement. And that's when they cannot really compare the two types of entities. So I think these are the two broad categories, but I think it's driven by the specific information needs. And I think some stakeholders appreciate that it's not possible to come up with a solution that would cater for those fundamentally different needs, information needs. I hope that helps and that addresses the question.
I see nods in here.
Good.
Thank you, Ralph. Sue.
Thanks, Andres. Maybe just to chime in on the software discussion or the systems discussion that you all were having. What struck me was, even though we asked questions about systems and software during the scope of the project, or towards the end, I would say, actually, I think that we part of the discussions that we had were actually with the software providers themselves about their readiness. And I'm not sure that, hindsight's always 20/20, but I think a lot of what we heard at the roundtable is those software providers weren't ready. And, we heard about companies having to double change. They went from one software provider to another software provider because this one who said they could do it couldn't do it. And so it was really eye-opening to me about how we consider costs and consider systems changes and what's available now, versus what might be available in the future. And, I might, with different lens, I might have thought about that a little bit differently. Of course, I wasn't on the board or made the decision at the time, but it certainly was an interesting debate.
Thank you, Zach.
Thank you. Yeah, I think I've said in meetings, it was interesting for me to come from a US perspective when the FASB was starting their PIR of the leasing standard and then switch over, because the feedback on that initial operating cost was absolutely consistent. It was global. It was the systems not being ready and the preparers not understanding how many leases they actually had, which was another big component of it. Going in. But what I wanted to really comment on was the ongoing costs, and not just the costs, but the benefits. So one of the interesting nuances, and the reason I was so supportive of taking on a project to sort of follow on that, was we didn't just have evidence about the ongoing costs of, in particular, the discount rates, but we also had evidence that the investors didn't value the precision of the discount rate we came up with. So we were sort of mounting costs and coming up with a very good technical answer on the discount rate. And then the investors came back and said, that's a nuance that we're just not getting much out of. So I don't know where we'll go, but it'll be interesting to see how we weigh what is a pretty converged answer on the discount rates and making changes to sort of strip out costs, being cognizant that we still want the comparability to the extent we can get it between a US preparer and a global preparer.
And that paves almost the way to the question that I would have asked, probably to all of you at the end of the first round, as to, okay, what does that now mean, given that we have made decisions to actually further investigate areas where we could take out cost, considering that we do have a converged or quasi-converged solution, because if we now make changes to the standard, then obviously this is a potential to further diverge. And the question is there any readiness on your board to actually follow suit and consider similar changes? I leave that for now. If you don't want to answer that,
I'll give you. I think we certainly heard some of the same issues as part of our post-implementation review. While we don't have an active project on that area, our PCC is actually looking at lease accounting right now, and has identified one of the areas being the modifications. Which I think is one of the actually more complicated, especially when you need all new assumptions. Discount rates are continuing a pressure. So I would say between the work they're doing, which our board participates in, there will be a question at some point in time, is it only private company or is it everyone? And you kind of wonder how this would only relate to private companies, but that's just my view. The other is, I think this is a good example where we will certainly stay in touch with you and understand what you're identifying, so we can understand, do we have similar issues here in the US, and can we benefit from each working together or not.
And I think that makes absolute sense. I mean, we wouldn't push any changes through without consultation anyway. And I think if there was a consultation, I see great benefit in actually having a sort of joined up consultation anyway, so that we tap the market at the same time and then digest the feedback that we are getting out of that.
Yeah, I think our communication vehicles and our sharing of information work well, and I think this will be another example where we can share information and each board can make their decisions.
Absolutely. And since you mentioned your PCC, it's worth mentioning that we did make the deliberate decision in our SME standard not to put in the disclosure and the requirements of IFRS 16 because we wanted to await the results from the PIR. We said it doesn't make sense to actually have SMEs undergo 2 rounds of changes. Firstly, implement the new model and then go back and do any amendments afterwards. Hilary.
I think a lot of my comments were more related to the ongoing costs associated with our smaller entities, right? I think to your point, the ongoing costs for the entities that have already had to adopt the leasing, software, for example, they're like, just don't change anything. But as Rich mentioned, PCC is looking at not just lease modifications, but also embedded leases and lease classification. And we do have a practical expedient for private companies to be able to use the risk-free rate as the discount rate. So that's something that we did, multiple years ago. But I do think it's something that still comes up, right? I think we kept thinking more education, more discussion about it, but it is a constant discussion of the ongoing costs of the leasing standard. So obviously, I think what you've done from an SME's perspective will be interesting, but we still have some questions that are coming in related to that and whether there's appropriate practical expedients or ways to reduce that without reducing the decision usefulness is something we continue to look at.
Thank you. And you just reminded me of another comment that I could make because we call our standard the SME standard. But we are all aware that this is really a misnomer because it's really the standard for non-publicly accountable entities, which may be large or small or medium sized. But I should remind everybody that those universe that is applying IFRS accounting standards, some 70,000, is probably only the top 10% that will qualify as being big companies, and the rest is really SMEs that are listed. So I think the concerns that you are hearing in your private company accounts are probably equally apply to those that are listed on a stock exchange. Right, Bruce.
Thanks very much. So I was very fortunate to actually yesterday attend a leasing industry conference. And it was very interesting getting some feedback I just wanted to give in. I mean, the first one was the resounding message of don't change it. We've kind of been through the implementation already. This is already in, and better the devil you know. So we've got it in. I think what was the most astounding thing to me coming out of it was we all talking about the software not being ready at the time. What amazed me yesterday was the number of companies who said the software still isn't up to scratch at the moment, and they're continually having to do manual overrides of the software systems to get these to do what they want, especially when there are modifications. They said that, and I mean, a lot of these were quite large businesses, but they said there's no perfect system out there. So when we talk about the ongoing cost, in a lot of these things, my experience has been that there's kind of the implementation, but then over time the software seems to be getting it right, and that makes it easier. The feeling I got from yesterday was that hasn't happened. The software is still just challenging, in terms of that. And I think it's because when you speak to some of these companies who I was talking to, some of them operate in 20, 30 different countries around the world. And they said as things change everywhere, it's different in every country, and how they determining discount rates may have to change because what's available in one country is different to what's available in another. And because of these nuances, they're just continually having to manually do these things. So that was a big change. What I thought was also quite interesting out of it was there was a very strong message of maintaining as converged as possible. So this was just coming from people saying, when I mentioned we were doing a PIL, saying, please don't go and do something drastically different. Because where they are working cross-border, they said that's just going to create even more cost in the system for us, where now we've got to go and do more differences between it. And then the last thing that's quite interesting was, and Andreas, you mentioned too that, I mean, wherever I've spoken to SME businesses, and we're not talking about the small one-man job, we're talking about the large unlisted businesses, we get great praise and thank you for not introducing this into them. It really is. And the reason for it is because a lot of them are saying that leases to them are quintessential operating cost. These are, unless you're taking ownership, unless you're in essence buying an asset, they're paying rental. That's what we see. It's a monthly cost. We put it into our cash flow. That's all we want to do. And anybody looking at those companies, that's what they're looking at. What is your monthly outgoing on there? They said for us to start capitalizing and doing this and then modifications, they said this is just good, would overcomplicate their lives with zero effort. The problem is, as you say, Andreas, is that the very large unlisted businesses are getting that benefit. The other guys are a bit jealous at the moment. So I think this is one of those we'll probably continually hear about saying, you know, we're not happy you did it, but don't change. So you kind of put in a stuck position on those two.
Great comment. Petrina, good afternoon.
Thank you, Andreas, and hello, everyone. Leases, always when the topic comes up, cost was always, of course, an issue and a concern. And I think we know why, because whilst they are financial liabilities, and we, have tried to develop a model that largely accounts for them like other financial liabilities, the sheer volume of them, of course, can just be enormous. And we know particular industry sectors, of course, can have not only thousands or tens of thousands, but even hundreds of thousands of these. So yeah, always a concern. And it's also, by the way, whilst I'm, why I'm supportive of us having a look at whether there's any way we might be able to reduce some of this ongoing cost, in a way that doesn't, reduce the benefits of the information too much. Just to reiterate others, I do think that thinking about that convergence piece is really important. That was sort of, the boards worked hard and worked well together to get that, the measurement of lease liabilities to be pretty much the same. And I think, at least in one respect, when we think about that, one of the topics that I know, Raf, you mentioned that we'll look at is actually picking up on where there is a piece of divergence, a small piece of divergence today in measurement around variable payments based on an index or rate. So I think that's something that we can look at because at the moment in our requirements, we require that updated measurement there, whereas in US GAAP it doesn't. So I think that's something good for us to look at. And I think, as others have mentioned, I think also where there is cost, of course, it comes up. And I think, Bruce, you touched on it well. Given that the discount rate is specific to the lease, it means that if you have leases in all different jurisdictions around the world, you're having to come up with discount rates, specific to where the leases are entered into. I think also maybe just trying to look at how frequently we require the discount rate, to be updated is somewhere that we can hopefully look at as well, and just see whether there's anything we can do there that might reduce some of those ongoing costs.
Thank you, Petrina. Rich?
Yeah, it's interesting. Your project's focused on one of the topics that I think we spend probably half our time standard setting on, which is looking at modification accounting. And, what's the right answer there, right? Is it every time you have a modification, it's brand new? Is it, no, that shouldn't be the case? I would actually put BizCom in the modification criteria because you change the counterparty and therefore we have a whole new basis. So it is kind of interesting. I don't have a good answer to it. I've thought, and we've talked over the years about maybe we should have one modification model. Well, that doesn't work very well since we have all different accounting models. But I think this is another example of, and sometimes the easiest answer or the theoretical answer on a modification doesn't play out well in either of those categories. So certainly be interested and certainly happy to share as we progress and as you progress on these related topics.
That sounds good. And obviously, we will be having a discussion about one particular type of modifications later on when we come to financial instruments, right? And there's another talk about this. I think these were all great points. I think with hindsight, when I review the standard being developed, it may be that we've tripped over our own feet in the search for the conceptually correct answer. You alluded to that, Zach, when we were dealing with the conceptually correct discount method. I also think about the famous discussions about the example when you do have a subscription to a seat in a stadium, whether that is really a financing transaction or whether it's not really just an ongoing cost, right? And you could obviously extrapolate that example to many, many others. So we all have ideas as to the assets that are being financed, and these seem to be clear-cut examples. The question is, the more you move away to an ongoing operational cost, it becomes difficult to actually distinguish between, is this an executory contract or is this really an asset financing? And I think there are good arguments either way, and it's very hard to actually draw the line completely. I don't see anybody else claiming the floor. So with that, then I would say that we move on to the next topic, which is a statement of cash flows. Okay, the team is busy joining. All right.
It's interesting. So we've done business combinations, leases, and cash flows. I think 3 topics where everyone knows exactly what the right answer is. It's just that they're all different, right? So this should be, I think, a good discussion. Let me see. Is Nick on? Do you see?
Here's Nick. Yeah, that's right.
Okay, so we're going to turn over to the statement of cash flows, and we're going to start with our friends across the pond. Nick, good afternoon.
Good afternoon. Good morning, everyone. Thank you. So let me jump right into it. So last time that the boards discussed the statement of cash flow and related matters project, the board had just set the direction for the project and was targeting 5 key areas, and including having an approach for considering the statement of cash flows related specifically to financial institutions. Notably, at that time, the board had also taken a tentative decision around expanding the NPM requirements that we have in IFRS 18 to also include those cash flow measures. So since then, we've continued to make progress on all of those 5 topics, and I'd like to just highlight a few of the key ones that we have set out in the slides. So a key one is just back in January this year, based on the decisions for proposals made up until that time, the IASB decided to move the project to the standard setting work plan. The significance of that meaning that the ultimate consultative document that comes out of the project will be an exposure draft. But working towards that then, the board has since recently made decisions around disaggregation and specifically focusing on strengthening that link between the statement of cash flows and other information. And it's done that by proposing some application guidance around disaggregation and labeling, and also enhancing the structure and disaggregation of some of the existing requirements around changes in financing liabilities. Our work around non-cash transactions has progressed significantly. We've had lots of productive discussions, both directly with investors and preparers, and also with our consultative groups. And we will be continuing to do that later this month with a discussion at our joint meeting, after which we'll take all of that feedback and have some proposals for the board to discuss. And then the last thing I wanted to highlight was probably the area of most overlap between our projects, is that around financial institutions. And we kicked off our work around that earlier this month with or I guess last month now, or early June. So it was just at the end of May, we had a chat with our financial instruments consultative group, who confirmed many of the messages that we heard in our initial research, and I think many of the similar messages that you've heard in the FASB project as well. We're still reflecting on those messages that we've heard and intend to continue the discussion with national standard setters at ASAF in early July, at which time we'll bring summarize all of that feedback back for the board to consider our next steps there. So that brief overview, I would like to turn it over to the FASB team.
Thanks, Nick. Richard?
Thank you. Thank you, Rich. Thanks, Nick. Good morning and good afternoon, everyone. I will begin with a brief summary of the stakeholder feedback from the 2025 ITC on the statement of cash flows, and then summarize additional input received through other recent outreach. So overall, ITC feedback was mixed on whether the board should prioritize a project on statement of cash flows. Stakeholders expressed a wide range of views, from redesigning the statements, making target improvements, to making no changes. Most stakeholders who support a project on targeted improvements suggest the objective should be to focus on making the information provided to investors more decision useful. Turning to targeted improvements, stakeholders identify several areas for the board to consider. Some of the suggestions include expanding supplemental disclosures, for example, requiring disclosure of cash interest received, similar to the existing requirement to disclose cash interest paid. and addressing certain presentation issues, such as the classification of operating lease within operating activities and the standardizing of free cash flow measures. Stakeholders also asked the board to reconsider whether codification language that encourages use of the direct method remains relevant, given its limited use in practice. In addition, some stakeholders suggest further disaggregation of certain line items, such as separately presenting maintenance and expansionary capital expenditures and disaggregating depreciation and amortization. Some stakeholders also supported improvements in areas such as presentation of share repurchase for share-based payments, specific guidance on how supply finance programs should be presented, and additional disclosure about non-cash items. Other stakeholders highlight recurring application challenges under current framework. These include constructive receipts and disbursements. For example, loan refinancing from one lender to another, in which the borrower does not have a cash inflow or outflow. Cash collect on behalf of third parties, for example, payment processors, classification of derivatives, and revisiting the definition of cash equivalents. Joint outreach related to a recently removed technical agenda project that focused on targeted improvements for financial institutions. Some stakeholders question the usefulness of statement of cash flows for financial institutions, noting that many investors assert they do not use it in their analysis. Stakeholders suggest a few alternatives, such as replacing the statement of cash flows with more targeted disclosures that will be decision useful for investors. The staff plans to present feedback from the 2025 ITC and other outreach to the board at a future board meeting, and it will seek the board's direction on the next steps. I will now turn it over to Rich to lead the discussion.
Great. Thank you, Richard. Richard mentioned this, but just want to emphasize. So we did have a technical project on statement of cash flows for financial institutions. In a recent board meeting, the board voted, the one thing we could all agree on, or at least four, was to take it off the technical agenda and subsume it into the research agenda that we have on the broader cash flow statement while keeping it as one of the areas of focus. So that's where we are. It's on our research agenda. We do not have a technical agenda project. And as you've heard from Richard, we probably got a lot of feedback like you did on the statement of cash flows. But let me turn it over to the group as we talk about the statement of cash flows. Oh, Nick.
Thank you. Thank you to Richard and thank you to Nick for the presentations. There are some similarities in terms of what we've heard. So when we did our prior agenda consultation, the feedback was mixed, but like what you heard, it was a top priority for investors. And so we did add that to our agenda at that time. There are some of the messages which you've heard around better linkages across the financial statements, improved transparency around non-cash transactions are very similar to what we've heard. I'd say one different direction we've taken is around free cash flow. There we have tentatively decided not to define free cash flow. I think my feeling is that tends to be entity or business model specific, and it's quite dangerous to define it, but we have tentatively agreed to introduce NPM. So if companies are using those types of metrics, we could have a cash flow, or they could have a cash flow NPM, which they would then reconcile that metric back to an IFRS number. I guess the piece which I'm intrigued about is the financial institutions work that you've been doing, because again, very similar messages, limited usage. And what we've heard from the institutions themselves is they'd rather not invest any more money in the cash flow statement. So if we want to make improvements, they don't want to replay in that game because it still won't add benefit to them, I think. So I saw that there had been some discussion on your side about replacing with selected disclosures, and I'm intrigued around what those could be. We've heard some suggestions, perhaps from other standard setters, of looking at regulatory information. I'm not convinced about duplicating what's readily available elsewhere within the financial statements. we've heard a derivative on that of could we have a reconciliation from regulatory information to IFRS numbers within the financial statements? Again, we'd have to think about the value of that. But I'm interested in terms of where your thinking had been going in terms of the replacement piece.
Yeah, Nick, I have an idea. The next two people I call on are going to answer that. So let me go to Hillary and then Fred and make sure. I think they'll answer your question. But go ahead, Hillary.
And Nick, I think you're hitting on something, right? That from a feedback perspective, we don't get a lot of consistency, right, across the board when we think about feedback on the cash flow statement, except related to financial institutions. And the fact, even from an investors, right, investors have pretty much across the board said we're not using the statement of cash flows from a financial institution perspective. So I think Fred will probably talk a little bit more about if we were to replace, we're not saying remove, but replace the cash flow statement with other information in the footnotes, what would that be? But I think part of it, you're also catching us. We have a board meeting next week where we're talking about the statement of cash flows. So we probably don't have fully, formed perspectives that have been publicly aired yet. But I think part of the discussion we're going to have is the order of operations, right? And I've noticed in your project, right, you're going through and looking at what are the improvements that we could make, and then coming back to take a look at whether or not those improvements are things that would move the needle one way or another from a financial institution perspective. I was curious if you think that you've identified any of those targeted improvements. You guys have been making great progress on your project that you think would move the needle, that might cause you to think that there could be changes made to the statement of cash flows that could improve the decision usefulness for financial institutions. From a personal perspective, I will say I'm very hesitant that I think that we can make changes to the cash flow statement that are going to make the cash flow statement useful. So I'm probably more of a proponent of flipping the order of operations and saying, if we don't think investors are using the statement of cash flows, that is a cost that's being borne by a system that's completely unnecessary. And I would rather get rid of that first. And I think to me, those are two totally separate projects. But I'm curious if you've heard any feedback that should have me think about that differently.
Fred?
Sure, and thanks. And I'll try not to duplicate Hillary's statements. I mean, I think what we continue to find out is that outside of financials, the statement of cash flows is used extensively by users. And we would really like to learn from you about any improvements that we can make to that because of that very extensive use by users. Within financials, I think the team has worked hard over the last year because initially we said, hey, could we reformat that statement of cash flows for financials? But my characterization of it is that the subtotals that we use in the statement of cash flows simply can't be reconfigured to work to provide meaningful information for investors for financials because their business is money and is cash. And so as a result, operating versus financing really can't work. And so I think so from my standpoint, though, it's not as though for financial institutions, the concept of cash earnings is foreign to them. In fact, as a quality of earnings factor, cash, whether something is cash or non-cash in financials is very important. Just think of going into the financial crisis and the issue of non-cash gain on sale and how important indicator that was. So there are key concepts here that are important for financial institutions and their investors. So, I think what we're trying to explore, is there a disclosure option potentially that, for financial institutions where they could provide that key information that users need about cash flow that doesn't work in the statement of cash flows. And I mean, one of the things that we're exploring is if we had a cash interest income, a reconciliation of that cash interest income with cash received and cash paid back to the net interest income on the income statement. I think, correct me if I'm wrong, I think we've gotten some fairly positive feedback in the limited outreach we've done on that. And there would be probably another handful of items that are critical for bank investors to think about the quality of earnings, so it could be part of that.
Okay, thanks, Fred. Zach?
So I'll give a quick answer to Hillary's question on the order of operations. I think the feedback I've gotten as we've gone through this has been a little bit more nuanced, where investors do say there are discrete items of information that they do find useful for the cash flow statement, which might influence the order of operations. So unless you replace those, how do you get rid of the cash flow statement if they are using them today? And then I think similar to what Fred said, I think there are incremental items of information, sort of that cash versus non-cash difference. If you think about the proliferation of PIK options today, that certainly affect financial institutions that have ownership of those assets and even liabilities that can PIK as well. The one question I have, though, that I'd be interested in hearing from the FASB is, because you have already spent some time thinking about the reorganization, one of the really deep fundamental questions I think we have to answer that's going to be the most challenging as we get to this FI question later is, what is an FI? Because we've got entities that are banks and insurance companies, and those are very clear, but then you get into asset managers and you get into brokers and things like that, or you get into manufacturing companies that have equally large financing operations for those. And so I was wondering if you've gotten any feedback on how to sort of delineate and think through where to draw the line there.
I think it's safe to assume that detailed scope issues we did not flush out. We do benefit that we have a section of industry guidance that is specifically, let's say, lending institutions, and that's already scoped. But ultimately, if there's something better, how far to go, I don't believe we as a board ever reached a consensus on that, Fred.
No, that's right. But conceptually, the way we're going on that was to say, okay, we would probably likely narrowly define kind of banks. And then we had a second part of the project, which is cash interest received, as well as cash interest paid. And that cash interest received, the part of the goal, correct me if I'm wrong, at least in my mind, was that would allow us to capture those financing arms at what would be considered non-financials.
So suffice it to say, didn't finish, and something to look at. The other item I just mentioned, and I think you'll hear it as we go around, we also, I don't know, ever really got an answer on, did people agree what was the purpose of the statement of cash flows? Meaning, was it a cash-based income statement or was it something else? And you may hear some different views on that as we discuss it also. Bruce?
Thanks very much. So just a couple of reflections on some of the target improvements that you've been looking at. I mean, the one that always interests me is the operating lease presentation, because to me, the challenge on that is, we've just spoken about leases, and we've all taken a fundamental decision that these effectively are financing liabilities. I mean, that's in essence what they are. So how we now reconcile that in the cash flow statement to doing something different to what you do in other things will be quite interesting to see. Is it a separate presentation looking at outside the cash flow where you net them off? Is it within that? So that'll be interesting. The other one I was going to point out was just on the free cash flow. So I'm one of the minority on our board who think we should be looking at free cash flow. I like it as a metric. I think back to some of the discussions we had when we were discussing things like EBITDA and operating profit, and would we ever get a standard definition? And I think we did get one. And I appreciate they are done differently. But I think to me, some sort of standardization, if it's free cash flow, if it's net debt, some of the standardization to me gives people a common starting point that I'll be interested in following to see what you guys do on that. I was just going to comment on the banking, because I mean, I think this is a fundamental problem we're all facing. I mean, to your point, we don't have the answer. We'll be watching eagerly your board meeting. Hopefully you guys will have the answer, because we don't have it right now. And I think the problem is nobody does, because I think the challenge with this, as you're saying, is quintessentially this doesn't work for the banks. And wherever I've spoken to banks about cash flows, I mean, their answer has just been, guys, just drop it. I mean, I say to them, well, if we weren't going to drop it, what would you give? And they're like, but we're doing this in regulatory reporting. We're doing this outside. Investors are getting what they want. So I think it's going to be an interesting challenge for both boards as we're starting to go through this, deciding, are we going to stick with kind of the project of, well, we're going to do a cash flow, and are we not? What I thought was interesting is our approach we took was, we were going to first do what we call the general cash flow model. So for the non-FIs, and then at the end come across and say, okay, now that we've got the solution, do we think this is going to work for people outside or within the financial institution space? The more we're going along that project, the more I'm convincing myself, I don't think we're going to get to the end and go, oh, suddenly this works for FIs. And I think we're really going to have to look at it within that. But I think the one thing we have committed to is that we're not going to kick the can down the road and say, well, we'll do this as another project and make it the problem of somebody else. We need to do this as part of this project. Otherwise, I think we've missed a big gap in terms of one of the reasons we took it on.
Bruce, just a quick question. Do you guys have a precedent in IFRS for not requiring the cash flow for certain industries? We do. We have it for broker dealers, for investment companies. So we already have been down that path somewhat.
Then you're ahead of us. We don't have that. We're required for everyone.
Right. Okay. All right. Higi.
Thank you. So I think listening to you and the feedback that you receive and identifying the similarities is just amazing. And I think most of it is really split between those financial institutions and the others. And in every discussion that we have, we hear the same things. And I think as we staged the project, and financial institutions are very much part of it, we said, let's deal with everyone else and then just ask financial institutions, can you deal with our other proposals in terms of cost benefit? And the last time we've tried to do that was with our financial instrument working group. And it wasn't a discussion. It was because every topic that we raised, they said it's just not relevant. And I think we pushed really hard, especially on the investors there. Are you not using it at all? They said, not at all. And then is it because of the information that you have outside? And I think one of our board members asked an investor, if you didn't have this information outside, would you use it? No. It's just not useful for us. And I think it's a good lesson for us to take back. And it fits to how we stage the project. I think for me, an interesting bit of work is not only the scope, how do we scope them if we do and we find a different solution, or just they're not presenting a statement of cash flows at all, is what kind of solution that we have for banks compared to insurers. Because I think for banks, we always think of the interest rate, the interest cash flows or quasi cash flows. For insurers, it's a bit different because in their insurance liability, you don't have an explicit interest rate. So do we need something else? But I'm also very mindful that both insurers and banks have done a lot in the last 10 years in terms of improving their financial reporting with 9, with IFRS 7, and with IFRS 17 for insurers as well. So I think there's a lot out there. So there might be a very good reason why cash flow statement does not add value here. And then I think for us, we spoke about convergence. For me, it's never a blocker. I think it's a huge opportunity for us to learn from each other and see, we may take different steps in different order, but we can learn from that. So that's a great opportunity for us. Thank you.
Thanks, Higi. Christine.
So I guess I'm going to be the optimist in the room about the possibility of finding a solution that might work for both financial institutions and non-financial institutions, because as Fred said earlier, there is a key metric for investors in financial institutions, which is cash earnings. That is a number that doesn't matter whether you're following financial institutions or non-financial institutions. That is a really important piece of information for investors. And I think it goes back to the discussion of what's the purpose of the cash flow statement. If the purpose of the cash flow statement were envisioned to be to provide a measure of cash earnings and non-cash cash flows, then I think that could work for all different types of organizations, regardless of what type of business they're in. But that would take a recognition that the operating, investing, and financing classifications that we currently have interfere with investors of all types' ability to figure out what cash earnings actually are. And that those categorizations are just not working for financial institutions. They're really not working for anybody. And so I just would, I think at some point the boards need to go back and really seriously think about what is the role of the cash flow statement in the entire package. And that metric of cash earnings would actually help with your comments on the free cash flow. because it would give a number on the cash flow statement, which would be a consistent starting point for investors to calculate free cash flow and do whatever adjustments they want. So right now, the commingling of cash flows related to earnings and cash flows that are not related to earnings across all three categories in the cash flow statement is a problem that I think is solvable.
Okay, thanks, Christine. So I have Bertrand, Joyce, and Bob, and while we were ahead of schedule, you can count on the statement of cash flows to kind of make up for that. So maybe the three of you, and then we'll head into break. So Bertrand.
Thank you, Rich. I will try to be brief. Some commented on the benefits of any form of information in relation to cash flow information for financial institutions. What was quite striking at the last FICG meeting is not only the preparers present whether, well, there was only one insurance company, so maybe to nuance the feedback from insurers there, but all the banks present were saying not only it's not useful, but it's also very costly to prepare. And I think there we will have to appreciate the equation of any incremental benefits versus any remaining costs in the ecosystem as a whole for both the benefits and the cost, with of course a focus of the benefits for investors and the cost for preparers. But the fact that it's not useful for financial companies and costly to prepare for financial companies makes it a harder cut, I would say, to be able to state that the benefits will exceed the costs. And I would say it's also the same for the whole of our project. And I think at the end, we'll have to step back based on all the decisions we will have made and appreciate each of us and collectively whether the benefits genuinely exceed the costs. Thank you.
Thanks, Bertrand. Joyce?
Thanks, Rich. I'd like to address a point that we perhaps have not addressed yet, but one that I'm hearing quite often by stakeholders, and it pertains to the benefit, one of the benefits listed on the slides in the IASB package, where investors have told you all that improved accessibility to information about non-cash transactions disclosed in a single location would be quite helpful towards their analysis. And I've heard stakeholders say that as a result of automation and technological advances, that investors should have less of an issue in terms of navigability and accessibility to information, and therefore improvements that might relate to sort of reformatting or taking the content that exists today and placing it in single locations really is just a matter of juggling around information, where in today's environment, AI can allow an investor to pull that information quite readily. Are you hearing that aspect coming from investors at all, where users are saying that, you know, the single disclosure may not be as necessary as time progresses because of potential future advances? And if so, are there conversations from large institutional investors versus perhaps smaller or SMEs who, you know, might have analysts who cover smaller companies may have a different view?
I think Aida's going to answer your question quickly. And then Aida?
I get a hint, Rich. Yes, thank you. Thank you, Joyce. And Rich probably knows this is, I'm going to touch on digital reporting and taxonomy. So I think just the main thing with accessibility of information is you need to be able to identify what the information is. And that report, for example, has to say this is non-cash transaction explicitly for that to be picked up by computer. And we find this is not happening today. So I think at that basic level of just identifying what information is, we need that improvement. And then I think single location is probably a little bit longer conversation we can have another time, but I would argue that can also facilitate information being found more easier, although there is a case to say as long as it's clear what it is, it shouldn't matter potentially that it is in 10 different places. Rich, did this meet your criteria?
Yes, you did. Thank you very much. Bob?
Yeah, before I come in, Flo, did you want to come in on Joyce's question?
Yes, thank you. I think, Joyce, I think you raised a very pertinent point. And by the way, thank you, Bob, for letting me skip the line here. I think what we're hearing from investors is not so much primarily the issue with single location, because I think that'll help too. But I think what we're hearing from investors is they can't make the linkages, they can't make the connections, right? So even if the information, the information is just not there, so they can say, okay, this belongs to this, and this is how they all fits together. This is, I think, is sort of covered both in the issues of linkages, which Nick talked about originally, but then also in some of the non-cash transactions part of the business, right? So it's not so much, can they process all that information? Well, the information isn't there to process in the first place, I think is the real issue. Thank you.
Thanks, Flo. Bob, back to you, then Rika, and to wrap us up.
Okay. Thank you, Rich. And I did get your message, so I will scrap that 20-minute presentation so we can get to the break in 4 minutes. 2 points that have been raised, but I want to add something to it. The first is on financial institutions. We did raise that with our financial instrument consultative group, where we have both users and preparers, both from financial institutions, insurance, and outside. And yes, the message has been, as everybody has said, it's for them, financial institutions, the statement is not very useful. But we did ask, what is useful? What do you use instead? And what the answer that came back, at least I heard, was from the users is some of the information, liquidity information, et cetera, that are coming from regulatory reports. So I think that's something we should be taking a look at. But I wanted to convey that to you also. My last point is, this statement is largely, our standards are largely converged. I'm hoping that we could stay that way. The area that I have the largest concern is on free cash flow. We did ask the question about, do you want the statement reordered to come to a subtotal for free cash flow? And the answer I heard back was no, don't do that. But yet we still had the calls for standardization for free cash flow. And as we got into it, we found it very difficult to come up with a single model to do that, particularly when people wanted us to build in some differentiation between growth and maintenance cash flows, and just couldn't come up with a solution for that. Now I realize we have MPMs where in US GAAP you don't have that, and so that may cause us to come to different conclusions. But I'm hoping still we could share information and hopefully stay converged.
Great, thanks, Bob. Rika.
I just quickly respond to this question about the objective of statement of cash flow. I mean, our standards consider that statement of cash flow is central to providing information around how entity generates cash and cash equivalents, and also how they use it. So I think, and then when the past discussion in the IASB, when they developed that standard, they consider that regardless of nature of activities entity engage with, they consider that the statement of cash flow is the tool that provide the information to meet those two objectives. So I think it's really unnecessary for us to stick to the statement of cash flow itself, but we have to find a replacement of a way of the use of the cash flow to meet that objective, I think.
Great, Rika. And I think that's a great way of summarizing the challenges that we'll face globally around what's the best way to present cash information in an accrual set of financial statements, right? Which it's kind of bolted on. So one of my favorite US movie quotes, and I'll change it slightly, is "If we build it, will they come?" Which I think is a challenge that we will continuously face with the statement of cash flows and alternative measures. So look forward to hearing your progress and sharing our progress on that as we attempt to deal with this issue. So with that, we are 1 minute early, but we're going to take a 15-minute break. So here in the US, it'll be 11 to 11:15. I think for our remote participants, 4 to 4:15 or 16 to 16:15. So we'll see you back in 15 minutes. Thanks, everyone.
Okay, I suggest that we keep going. Thanks very much for being so diligent and coming back on time. Now, the next slot will be interesting. I've said we've reserved an hour for 3 very interesting financial instruments topics. I try to steer us towards that we get every slot done within 20 minutes, but if there is a little bit spillover, that just means that it will make it harder for Rich to actually take us through the rest of the meeting. So please stay diligent. All right. So we start with the first topic on broadly modifications, amortized cost treatment, and I hand over to Dan to kick us off.
Yeah, thanks, Andres. Good morning, everyone. The meeting materials at AP 36 provide an overview of feedback that the FASB has received on the accounting for troubled debt restructurings, or TDRs, and debt modifications and extinguishments by borrowers. Starting with TDRs, it's worth noting at the outset that TDR accounting for borrowers has resulted from guidance issued in the late 1970s and is not converged with IFRS. The FASB's heard feedback on this topic from the 2025 agenda consultation, which was reinforced by discussions with the FASB's Private Company Council, or PCC, and the AICPA's Technical Issues Committee, or TIC, in addition to targeted outreach with users. The overarching theme is that current TDR guidance is unnecessarily complex, and many question whether it provides decision-useful information. The most frequent cited concern is that the accounting outcome when modified undiscounted future cash payments are less than the current carrying amount of the debt. Under current GAAP, the borrower recognizes a gain upon modification and does not record interest expense going forward, regardless of the stated rate of the debt. Stakeholders say this does not reflect the economic substance of the ongoing debtor-creditor relationship. That said, there is mixed feedback on whether this area should be prioritized by the board. Some stakeholders told us that TDRs are a top priority because of the complexity involved. Others said it is a lower priority because the guidance is well understood and restructurings often do not result in TDR accounting. However, some noted that TDR accounting often becomes more prevalent during economic downturns. The most common suggestion to improve current GAAP was to eliminate the separate TDR model in subtopic 470.60 and require all debt restructurings to be accounted for under the modification and extinguishment guidance in subtopic 470.50. Several stakeholders also pointed out that the board already eliminated the TDR accounting for creditors with update 2022-02, and they encouraged the board to consider a similar approach for borrowers. Some also suggested that if the TDR accounting were eliminated, the existing TDR disclosure requirements should be carried forward and applied to all modifications. At the FASB's Investor Advisory Committee, or IAC, meeting last week, committee members observed that TDRs are off-market transactions and emphasized that the post-restructuring principal balance should reflect the borrower's contractual obligation, and periodic interest expense should reflect the cash coupon under the modified note. Turning to debt modifications and extinguishment guidance more broadly, stakeholders told us that subtopic 47050 is complex and that the modification accounting is the most frequent outcome, which can also result in unintuitive financial reporting. On the surface, US GAAP and IFRS have some similarities in this area. However, under US GAAP, a 10% cash flow test is used to determine whether the modified terms are substantially different. And substantially different terms is the threshold for applying extinguishment accounting. US GAAP does not permit a qualitative assessment. The specific challenges stakeholders highlighted usually focus on the 10% cash flow test. We've heard feedback on how this test is applied when the debt is non-prepayable and when contemporaneous changes are made to both a term and a revolving facility the borrower has with the same creditor. Syndicated lending arrangements are also commonly referenced because the cash flows must be tested for each lender in the syndicate. Some stakeholders suggest the current GAAP can be approved by expanding extinguishment or modification accounting, or by replacing the quantitative 10% threshold or 10% test with a qualitative principle-based framework. Others prefer more targeted amendments to address pain points while preserving the overall model. So with that, the meeting materials walk through current US GAAP and the feedback in more detail, and I'm happy to answer any questions on those, but if there are none, I'll pass it back to Andreas.
Thank you very much. Let me just see whether there are any instant questions. Otherwise, I will turn it to Lyra and then open it for both boards afterwards. Didn't see any tags or hands raised. So Lyra, can I pass it over to you?
Yes. Thank you, Andreas. Hello, everyone. So Agenda Paper 11 summarizes the IASB's deliberations and tentative decisions reached so far on its amortized cost measurement project. Now, this is a project that the IASB started in late 2024, but most of the deliberations happened last year and continuing this year. The board started the project because during the post-implementation reviews of IFRS 9, it received feedback that there's been long-standing application issues regarding application of amortized cost measurement requirements. And I say long-standing because a lot of these requirements that are causing these issues in practice were carried forward substantially unchanged from the previous standard, IS 39. So the practice issues that stakeholders raised were broadly in three themes. The first is issues regarding the effective interest rate, so both how to calculate for particular instruments on initial recognition, but the more important questions were around which cash flows should be accounted by subsequently changing the effective interest rate. The second group of issues is to do with modification accounting. So that's stakeholders reported that the guidance currently in IFRS 9 is not sufficient to determine the accounting when it comes to starting with what constitutes a modification, but also with in relation to how to assess whether a modification is substantial, because that's the threshold that then leads to derecognition accounting. And the third group of issues is in relation of the boundary between modification, derecognition, and then impairment. So in relation to modification accounting, currently IFRS 9 also references what's called the 10% test, and this is one of the only application guidance that currently sits in IFRS 9 in relation to how to assess whether a financial liability that's modified, whether it's substantially different after modification leading to derecognition. So the questions we've received here is how to calculate the 10% test in particular financial instruments and particular circumstances. Does it apply only to financial liabilities? Because currently that's where the guidance sits in IFRS 9. But also, is it the only analysis that needs to be done on, or should there be more qualitative analysis? And then in terms of financial assets, the question is, can they apply the 10% test? But in practice, what we've learned is that entities, because IFRS 9 doesn't provide guidance, they've developed their own policies, and they mostly look at qualitative analysis of factors, which has led to some diversity in practice, because the factors entities look, they're not consistent from entity to entity. So in terms of what the paper covers, what you see on slides 4 to 6 is a high-level summary of what the board has tentatively decided in this project so far. And then what you see on slides 7 to 8 is some preliminary thoughts from staff about what the qualitative analysis could look like. It's not well formed yet, so the board is expected to have a more thorough discussion about what that guidance could look like later this month. In terms of the next milestone for this project, the board is working towards an exposure draft. And later this month is the plan also is to review the timeline for that exposure draft in the light of some of the scope decisions that has been taken in the April meeting. So with that, I'll hand over to you for discussion, and I'm happy to answer any questions or comments.
Thank you very much, Lyra and Dan. Okay, floor's open. Who would like to get us started? Hilary.
I really appreciate talking about both of these topics at the same time, because I think it's interesting the feedback that we've heard on modifications of debt instruments. If we kind of step back from an investor perspective, right, we have a model today that gets you under US GAAP, you're almost always in the modification test, right? So you end up having to adjust your effective interest rate, which ends up with a very, sometimes very significant difference between your contractual interest rate and your effective interest rate, based on the fact that because you made the changes with the same existing creditor. But if you would have entered into a new debt instrument with a different creditor, you would have no disconnect between the interest rate, effective interest rate, and contractual interest rate. So from an investor perspective, one, I'm not sure that they really think that's decision useful to have that disconnect from an ongoing basis perspective. And I think in the past, the accounting guidance was really meant to not have an extinguishment gain or loss, right? There was really a focus on extinguishment gains or losses maybe are bad, so we're going to adjust the interest rate going forward to reflect the difference in the changes in the terms. But what we're hearing, I think, from investors is the changes, when we account for it under a modification, it's not particularly helpful from them. It's just further away from the actual terms of the arrangement that the entity is now subject to, which I think has really caused us to step back and say, maybe not do we need to make improvements to make it easier to apply the modification or substantial, whether you've had a substantial modification test, but do we even need to have that test at all when we're thinking about changes in debt arrangements? And when we've talked with investors, I think they have indicated that they have found the debt extinguishment, that gain or loss upon a change in your terms, as decision useful, provides them information in the period in which the modification of the terms occurred. And they don't need then kind of the complication associated with a new effective interest rate going forward. And so I think that has kind of caused us to look at this project probably differently than we even thought about when we took on this project or heard the feedback from the agenda consultation. Now, I do think it's fair to say that investors might think of different modifications differently, right? It might be, why are you making the changes to these arrangements? People want to know if someone is in financial difficulty, if you're entering into this at off-market terms. But I think there's potentially arguments to say you could provide disclosures associated with that without having to have kind of a separate model for looking at those as we do with the TDRs today. So just something that I think as we kind of look at this, and I know we've been following your project as well, of just whether you're getting similar feedback, if there's any sort of feedback from investors that is making you maybe think about the modifications of debt instruments in a different manner.
Interesting. Christine.
Did anybody want to respond to Hillary's question before
the only thing that I could throw in is there's a difference between the conceptual answer and how investors look at certain types of modifications. And what we have seen is if there are regularly occurring modifications, but these are not really one-offs in the sense of there's a significant event that has happened. People are more happy to actually just carry on and don't have a disruptive treatment. I presume that this will be the case in here as well. If not, then I don't know. We hadn't really had an in-depth discussion about this.
Yeah, Andres, I would say we haven't heard that investors want to make a distinction between normal ongoing, restructuring as part of your normal course of business versus you've had some significant credit event or something. They think they're kind of all the same. They don't need a distinction is what we've heard so far.
So that would constitute probably a difference in there. But I'm happy to also have Zach, Nick, or Flo, if you have heard anything different to that.
I could come in and say that this is something we took not just to investors as a whole, but we also took to the investors and the preparers on our financial instruments working group, which I don't know if we've talked about that before. It's a newly created group because we needed people who specialized in financial instruments rather than relying on the general preparer and investor group. And I was a bit surprised by the answer. I thought investors were going to ask for some sort of signal when there's been, and if you're just talking about one or two, it's not material, so it wouldn't show up. But if it was a wave, then it would show up and you would get some signal. But that's not what we heard. So I think it broadly reflects exactly what you said. They were just like, just tell us what the interest rate is moving forward and we'll work with that. I think we still have some thoughts around whether that's going to be enough. And, do we add disclosure? But to your general question, yeah, the feedback is almost identical, I think.
Flo, Bob, is that on the same question?
For me, it would be. So yes, and just to echo what Zach said, and again, I think the discussion for us is to think about also a symmetric treatment between financial assets and financial liabilities, and how we sort of distinguish between modification and extinguishment, or derecognition between those. And I think the preference here, and this was kind of core to what Zach said, was generally investors prefer to have the number in there that is most reflective of sort of future cash interest inflows, because that is what they're most interested in modeling going forward. And I think we come more from a page where we had, I don't know, more extinguishment. But yeah, I mean, so, but I think it was this forward-looking cash interest that they wanted to get at.
Bob, on this issue?
Yes. So I appreciate the feedback and hearing the feedback that you're getting. And it's not that distance from the feedback that we're getting. I think the dilemma, though, if I can maybe come to one of the things we need to think about is it's a range of situations, right? And I could give you on one end of the range, it's a modification that you agree it just wasn't that, it's not substantially different and it should be accounted for in one way, and then give you the other range, end of the range, and you say, yeah, it's substantially different and should be accounted for as an extinguishment, and then you've got a blurry middle. And so where do you draw the line? And I appreciate this, what we've had in the past of a 10% test, and putting aside the complexities of it. At least the advantage was it created some standardization. Everybody did it the same way. And I think, the grass is always green on the other side, and maybe this is not really the right test, but the question in my mind that we're going to have to face, and I wonder if you're going to have to face, is, well, okay, you want to bring in some more judgment into this, but how much judgment? How important to the user is standardization versus judgment in this area?
Fair point. Christine, you have been very patient.
I thought that was a great discussion. So I view things very similarly to the way that Hillary was describing them. And I'm not sure that we necessarily view this differently, but I guess when it comes to TDRs, which are truly off-market transactions because a company is in financial difficulty, I do think that the model needs to be different for those types of transactions, because pretending that they're taking place on market can lead to some very odd outcomes. And luckily, TDRs are not run of the mill. They don't happen all the time. They should be quite rare circumstances. And so it's not surprising that the accounting wouldn't be used all that often, but when it is needed. So for example, if there was a big downturn in the economy and a lot of companies ended up in financial difficulty, I think we would have a hard time explaining why it was that if we went to an on-market type of accounting for those transactions, why companies were reporting large gains as they restructure, and then that's offset by large interest expense amounts on a go-forward basis, none of which is actually related to the cash flows. And I have to say, I sort of scratch my head a little bit when I look at the type of transaction that we had on slide 4 of the materials, with the undiscounted cash flows less than the carrying amounts. And when I look at that transaction, what I see is a company borrowed $100,000 and they're only going to pay back $96,200. So there is no interest. In fact, they're not even paying back the full principal that they borrowed. And the accounting demonstrates that. It just says there's an upfront gain because you got a forgiveness of principal of $3,800. Then all your payments after that are going to pay back the principal that you originally borrowed, which was $100,000. I struggle to see how changing this accounting to record, to discount based on an interest rate that is not actually ever being paid, and recording an upfront non-cash gain offset by large interest expense, which also is non-cash, all of which will just wash in the end, provides useful information to investors. So, I think where the benefit could really be made in this area is probably in the accounting for regular on-market transactions, and a move to extinguishment accounting away from modification accounting would make things better for investors and also reduce costs for preparers.
Thank you. Anybody else on that topic? No, then I would suggest that we move on to hedge accounting and risk mitigation accounting, starting with an overview of our RMA project. Ziki, over to you.
Thank you, Andreas. And hello, everyone. Agenda paper 4 provides a brief update on the risk mitigation accounting project. As you know, the IASB published the exposure draft in December 2025 and decided last month to extend the comment period to 30th of November 2026, which is also the deadline for fieldwork results. In the exposure draft, the IASB proposed a new accounting model designed to better reflect how financial institutions manage interest rate risk. The intention is that once the RMA is finalized, it will supplement the general hedge accounting requirements in IFRS 9 and inform how and when IAS 39 could be withdrawn. Since the publication of the ED, we have undertaken extensive outreach to understand areas of particular concerns from stakeholders and to clarify potential misunderstandings, and we will continue to do so during the remaining comment period. Thank you so much. And with that, I'll turn to the FASB team, if I remembered correctly. Thank you.
You do. Thank you. Erin.
Good morning. The FASB currently has 3 projects on its agenda that we are working on concurrently. Those projects were supported by the feedback that we received in the 2025 agenda consultation that said that hedge accounting is in need of improvement because it's complex, does not accurately reflect common risk management strategies, and results in the use of non-GAAP metrics, or entities just forgoing the use of derivatives altogether for managing risk. And we understand that that feedback is consistent with much of the feedback that the IASB has received over the years. The board decided to address the feedback in 3 stages, and each stage represents its own project. And that approach is responsive to the feedback that we received that while the FASB is researching more fundamental changes, to the model that there are opportunities to improve it in the meantime. So in the short term, the board is focused on making targeted improvements that could be accomplished relatively expeditiously with few amendments to GAAP itself. The most significant of which would be allowing hedging of interest rate risk for HTM debt securities, which is currently prohibited. And in the medium term, the board is looking to extend a certain type of fair value hedging called the portfolio layer method to liabilities. Today, that method is restricted to only assets. And in the long term, the board is comprehensively reconsidering the current hedge accounting model with the objective of making it more accessible and more reflective of risk management activities across all types of entities. So I'll spend a bit more time on that longer term project because it's the one with the potential for the greatest impact. So the staff is still actively researching and building out a straw man of that model, but I can just present to you broadly the direction of travel. And we will come back to the board later this summer to present the straw man. The objective of the new model would be to accurately reflect risk management activities in financial statements and provide more transparency for investors. By more closely aligning the accounting with the risk management function, the operability on preparers should be reduced. And the goal would be to improve the accounting for all entities that use derivatives for risk management purposes, from the largest global banks to small companies that maybe have simple strategies of converting a floating rate loan to fixed or hedging out some FX risk in their foreign operations. And the model would focus on accounting for derivatives, and it would aim to streamline the different hedge accounting models that exist today. So your fair value, cash flow, net investment, those three models, just move them into one model. And then finally, with respect to disclosures, we understand that there are a lot of hedging disclosures, and we often get the feedback from investors that they do not find them decision useful. And even for companies who do apply hedge accounting, they often use non-GAAP metrics to more clearly convey the effect of derivatives on their financial statements. So as part of this project, we'd be looking to revamp all of the hedge accounting disclosures with an emphasis on what is the risk inherent in the business before considering derivatives and the effects of using derivatives on an entity's risk position. So I'll go ahead and turn back to Andreas.
Thank you, and good luck to the project. Juliana.
Thanks, Andreas, and thanks, Erin. And good morning or good afternoon to everyone. Just to give you a brief overview of the IASB's post-implementation review project on the IFRS 9 hedge accounting requirements. As noted in the agenda paper, the IASB started its work on this PIR in Q1 of this year, and we're currently in phase 1 of the PIR, where we're gathering information from various stakeholders on whether the requirements are working as intended. And we expect to conclude this first phase towards the end of Q3, at which point we will then publish a request for information that will be open for public consultation. Now, at the time of developing the requirements, the IASB expected that the IFRS 9 hedge accounting requirements would become easier to apply for entities, mainly because the accounting is now better aligned with an entity's risk management practices. And in terms of disclosure requirements, the IASB also expected that the amendments it made to IFRS 7 would provide users with more decision-useful information, as they focus more on the impact hedge accounting has on an entity's financial statements than on meeting technical hedge accounting criteria. As you will remember, IFRS 9 was developed in 3 phases. We have classification and measurement, impairment, and hedge accounting, and consequently, the IASB also decided that the post-implementation reviews would take place in 3 phases, 2 of which we've completed, and this being the last one of the IFRS 9 requirements as written today. However, this PIR is slightly different to other PIRs in that not all entities will have implemented the new hedge accounting requirements, as entities can still apply the IAS 39 hedge accounting requirements. Coming quickly to the feedback we've received so far, I would say overall the feedback has been positive, with many saying the requirements are working as intended, and it seems that practice has become established in many areas. I guess this is not entirely surprising, given that IFRS 9 retained not only the 3 types of hedging relationships, but also the hedge accounting mechanics of IAS 39, rather than replacing them with a new model. However, what we've heard in a few areas that the IASB might need to investigate, such as rebalancing or the cost of hedging approach, which are apparently areas that some preparers are struggling with. In terms of usefulness of the hedge accounting related disclosures, I guess kind of similar to what Aaron just mentioned here, we're also kind of getting mixed feedback from users, with some saying that the information is not really decision useful, and we are hearing from some preparers that the cost of providing this information might be slightly too high. Nevertheless, it's still early days, and we hope that after evaluating the comment letters on the request for information, that we'll have a better understanding of these issues and also, more importantly, how widespread they are. With that, Andreas, I would hand it over to you for discussion. Thank you.
Thank you, Jana. Okay, Bruce.
Thanks very much. And guys, thanks for all the feedback. I'm really interested in this long-term project that you guys are talking about, because I mean, that's quite a fundamental change to what's happening. I mean, if I look at the feedback we've been getting and where I've spoken to people, the general message I've got is it's working. I mean, sure, there's some complexities, but kind of people are saying, other than bits and pieces, that they're pretty happy with our hedging models at the moment. And what I find is the only time people really have challenges with it is generally companies who are doing something complex. So they're not just hedging a FX transaction or a simple floating fixed drop. They're doing something out of the ordinary. And generally those are larger businesses, most of the time banks. They've got the people internally who can deal with that complexity, and they've got the systems and everything in place. So I was just curious around kind of, how you guys are going to make a decision around going through such a fundamental change when, I mean, from my experience, what's out there at the moment seems to be kind of quite well accepted. So just interested in a bit of background to that.
Bruce, maybe it's helpful to go back. This is a project on our research agenda.
Okay.
So it has not been added to our board agenda.
Right.
So some of the questions that you have will be some of the things that our team will have to present to the board to get a majority of the board on board with that decision. So.
Okay, and it just interests me because, I mean, from my point of view, if our team came to us and said we're going to put a long-term project on the agenda to research this, I don't think there's enough evidence to even do the research at the moment. So I was just interested in that.
So we may operate slightly differently. So our research agenda is controlled by the chair. Well, we certainly get input from the board members to make sure it's something there's an interest in. You'll also notice there's 3 phases to this project. Personally, I've always thought the biggest threat to the 3rd phase, meaning the major project, is the success of the prior 2, meaning did that address people's concerns or not? But we do continue to hear from some group of stakeholders about concerns about the overall model and the way it was put together, started fairly restrictively and then continuously amended for 27 years. Does it make sense? Does it hold together?
Maybe just to add to that, I mean, and Rich is right. I think part of it is we have done tweaks for 27, 28 years on this because we continually get feedback that, hey, this would be great. And a lot of it is because the standard is on hedging on a transaction by transaction basis, and that's not how many entities look at risk management activities. It's constantly being asked for, can you make that group of things we can hedge broader? And at a certain point, the staff will bring feedback to us and we consider the agenda requests that come. And it gets to a point where it's so broad, we can't really agree to move forward with it because it is kind of pushing up against those fundamental premises of the existing guidance. And so I think part of the relook from a broader perspective, and we did get quite a bit of interest in this as part of the agenda consultation process of, effectively, is it so broken and we can't fix it anymore without blowing it up? Is my short answer to it. So I think that's really what the staff is looking to do research on. Now, to your point, that's not the only feedback that we get, because we also get feedback from the folks that have a very simple strategy and our standard is still complex and difficult to apply. They're still not applying hedge accounting to, certain commodity transactions and things, because there's a lot of gotchas in our hedge accounting guidance today. It was written as a privilege, not a right. And I think there's a lot of things from a documentation perspective, from modifications, from effectiveness testing, right? We've made it very complex. And I think that's not necessarily where certain board members think the hedge accounting model should be. It should be applied if we think if this is how you're looking at managing and mitigating risks, being able to apply hedge accounting seems appropriate. So I think it's not just the big guys who have the complex business models. Certainly they are very interested in that. But I think it's also for the folks that look at the model that exists today and the inherent complexities and gotchas there, and to say, couldn't you make this easier for us to do as well? So it's a tough project because you're trying to address a very broad spectrum of stakeholders who have an interest in this issue.
Absolutely. And it probably will always be an overlay model, right? Because the underlying transactions you do have already an accounting model for, maybe either cost, maybe fair value, maybe a sort of a hybrid, right? So what you're effectively doing is you're putting a layer over it and try to nullify something. And I think that was part of the justification to put in the stringency into the model, right? Because if you wanted to have an override, you don't just get carte blanche, right? I want a solid justification, but maybe with hindsight, we've now been at a point where this is going too far, right? Fred.
Yeah, I would just, I think the feedback we've gotten is quite different than the way you characterized it, Bruce. I would say in the banking space, especially on the smaller side of banks, what we hear is and correct me if I'm wrong, staff, is that there's a fair amount of institutions who, either don't hedge oftentimes, don't hedge some of their interest rate risk because of the complexities of applying hedge accounting and the risk of ineffectiveness and what that could do to their earnings. And I think one of the things we've seen in academic studies already is that when we did kind of improve the model, open it up, we actually saw not only more use of hedge accounting, but actually more use of hedging, which, I think is an important aspect. Outside of the banks, the other thing we're seeing is that it's not if we're seeing a lot of economic hedging occurring, hedge accounting not being applied, and then non-gapping that issue. So I think on both sides, I wouldn't characterize it, the feedback at least I've heard, that it's working. In fact, I would say it's generally not working.
Hillary.
Oh, no, sorry.
No? Yeah, okay, Zach.
So I wanted to ask a question about this idea of a focus on sort of a pre-mitigation risk profile and then a post. Because one of the things I've encountered talking to investors is that one of the most confusing situations they have, and we've confronted this in our risk mitigation accounting proposals, is situations where entities use a combination of hedge accounting and don't use hedge accounting for economically similar transactions. And that's where you get this plethora of disclosures that don't reflect most of what the entity is doing or what the impacts on the financial statements were. Have you thought about sort of whether this would be simply on those activities that qualify for the new hedge accounting or whether it would be more broad?
So that is something that the board has not actively deliberated, but I think it's a good question and one that they will need to address.
I would just second Zach in that. So the decision to hedge is as much a decision not to hedge. And the decision to hedge account is as much a decision not to hedge account. So there is a management overlay that comes in that is masking the underlying economics that is there. And I think that was one of the drivers for us to consider a completely different model that has nothing to do with overriding the accounting, but was really start from the entity's perspective and saying, how are you managing risk? And how much of that could we actually mimic given our limited accounting toolbox, right? So whether that has more traction or not, we will see. Bertrand.
It's interesting to hear the FASB's thinking on the long-term project, which is about risk management. And it speaks quite well to me. I think it goes more to what we are doing in IFRS 7 in terms of disclosures around risk management for individual transactions, I mean. And if I think of some risks, the most common one for non-financial companies being FX, the first way to manage the FX risk in a group is not hedging. It's netting of the positions. Hedging comes eventually second, and hedge accounting as a third layer of the thinking. So I think risk management is certainly something quite interesting because it's broader than just focusing on potential technical effects. Thank you.
Thank you. I don't know whether you have a clock running by yourself as well, but we are very well on time. So I don't see any more tax raised. That means we could get to the third bucket, which is basically the distinction of liabilities versus equity. Jill, Angie, over to you.
Thanks, Andreas. Hello, everyone. So I'm going to give you a brief update on the FASB project. This project aims to improve information entities provide about issued financial instruments and address challenges with applying IAS 32 without fundamentally changing the requirements. So the FASB exposure draft was published at the end of 2023. It dealt with several topics related to presentation, disclosures, and classification. We received 137 comment letters, performed extensive stakeholder outreach, and there was general support for the IASB's efforts to address known practice issues. But overall, the proposals received mixed feedback, which was to be expected as this is consistent with the long-standing diversity in practice on many matters. Investors were particularly positive about the presentation and disclosure proposals, so the IASB started its redeliberation with these two topics, and at last year's joint meeting, we presented the IASB's tentative decisions on them. Since then, the IASB has been working through the classification topics aims to complete the technical redeliberations by the end of this year and publish a package of amendments in 2027. So one of the most technically challenging topics is the application of the fixed for fixed condition when classifying derivatives on own equity. And the ED proposed that for a contract to be classified as equity, the amount of the consideration exchange for each own equity instrument shall be denominated in the entity's functional currency, and it's be either fixed or vary solely because of preservation or passage of time adjustments which meet specified criteria. We received extensive feedback. Some stakeholders thought the proposals were too restrictive, especially for multinational corporations, which may be issuing derivatives through foreign subsidiaries and in foreign markets. And although there was general support for both having preservation and passage of time adjustments, there were some concerns about practical implementation or that the proposals would cause some common adjustments to fail. So the IASB tentatively decided to finalize the proposed requirements subject to refinements. And to address the concerns related to the proposed fixed exchange ratio, the IASB intends to clarify that a derivative could meet the fixed for fixed condition if there is a fixed amount of consideration and either a fixed number of own equity instruments or a fixed exchange ratio. And to make the terminology more understandable and less ambiguous, the IASB also focused on what the adjustments actually aim to compensate or what they reflect. So preservation adjustments will be replaced with adjustments that compensate the future holders of the equity instruments. And these adjustments must aim to place the future holders in a comparable economic position to that of the current holders and not expose the entity to any additional risks. And then passage of time adjustments will be replaced with adjustments that are solely a function of time. And these adjustments must be predetermined, vary solely with the passing of time, and not expose the issuer to any additional risks. So thank you. I'll now hand over to the FASB team.
Edward, over.
Yes, thanks for having us today, and good afternoon, everyone. In this portion of the session, we'll provide a brief update on the Indexation Debt and Equity Project, which was added to the board's agenda on March 18th, and the board completed deliberations on this week as well. We'll briefly touch on the current guidance in subtopic 81540, and then focus on the stakeholder feedback and the decisions that the board has made. At a high level, the project is focused on the indexation guidance within subtopic 81540, which applies broadly to equity-linked instruments such as warrants, convertible instruments, and other contracts indexed to and settled in an entity's own stock. The current guidance includes a two-step analysis that looks at contingent exercise provisions in Step 1 and settlement adjustments in Step 2 to determine whether a contract is indexed to an entity's own stock. Step 2 includes the commonly referred to fixed-for-fixed assessment, which requires an entity to analyze whether the instrument's settlement amount is consistent with calculations in a Black-Scholes valuation model and consideration of leverage factors. Feedback received from the 2025 agenda consultation and multiple rounds of stakeholder outreach highlighted similar themes. First, stakeholders noted that the current guidance is complex and difficult to apply in practice. Second, many emphasized that Step 2, which evaluates settlement provisions, is the area most in need of improvement. Third, stakeholders generally did not support introducing probability-based concepts because they thought it may add judgment and potentially increase diversity in practice. And finally, we heard continued concern about how the current guidance distinguishes between acceptable and non-acceptable leverage factors. In response to that feedback, at its March 18th board meeting, the board decided to pursue an approach referred to as the acceptable variables approach in order to make the guidance less complex to apply and understand and reduce inconsistent interpretation and application of the guidance. Under this approach, the existing Step 1 guidance would be retained with targeted improvements focused on the Step 2 guidance. The acceptable variables approach would remove the fixed-for-fixed analysis and not preclude indexation if the variables affecting the settlement amount are within the list of acceptable variables. This approach would also add the entity's own operations or activities to the current list of acceptable variables. Further, on Wednesday, the board clarified certain variables to address stakeholder concerns. Additionally, the board decided to add a clarifying disclosure requirement about the terms and features of equity classified contracts to enhance transparency, such as terms and features that could have a significant effect on the settlement amount, or contingent events that occurred and significantly affected the settlement amount. Lastly, the board decided to pursue a modified prospective transition approach and that there'd be a 60-day comment period for the proposed update. Thanks, and I'll now pass it back for discussion.
Thank you both. All right. Any views by board members? Challenges? Agreement?
I think we're all just happy we have made some progress.
Yeah. Well, I think that probably also is the same that I would say for us on our side, because some of the nets obviously have been cracking for quite some time. We will see whether people are in the end really equally happy or not, right? So we'll see. Hillary?
Maybe just one thing to emphasize. I mean, I know Edward mentioned it, but we do expect that more instruments will be equity classified, right, than exist today. So that's one of the outcomes we expect from this guidance. And I do think we've heard from investors that they find that with appropriate disclosure of the terms and conditions associated with those arrangements, that that's decision useful and potentially more useful than calling these liabilities and fair valuing them each period. So just to reiterate, that's very important feedback that I think really drove a lot of the decision making here to try and reduce the complexity, but still and improve the decision usefulness of the information.
And would these treatments be conceptually consistent with how they're being treated on the prudential rules? So would prudential regulators also classify those instruments rather than as core equity, as tier one?
Well, we do have different rules with regards to settlement. This is only addressing indexation, right? So there are still instruments that would be equity classified that under the SEC guidance would be classified as temporary equity. So that is one of the consequences, right? It's not necessarily addressing all parts of the guidance, but it is going to take away, I think, a lot of the cost and complexity and put more things into the equity bucket.
But when you mention prudential regulators, you're thinking banking regulators, and how I think a couple things there. One, the prevalence in the U.S. banking market of these instruments being issued. I'm not sure how extensive it is, but we already have differences, right? They make their own judgments about what qualifies and what level of capital.
Just real quickly, I wanted to comment that so the disclosures, you definitely see the through line from the FICE disclosures we have to these. I think when your exposure draft, I'm assuming it's going to be an exposure draft coming out shortly, comes out, I'm going to want to think carefully about how I describe the differences in like scope and the actual requirements to explain that to people of where we differ and what the rationale might be.
Okay. I think we've exhausted our firepower. Needed even 10 minutes less for financial instruments. Okay, thank you very much. Thank you, team, on both sides. And I hand it back to Rich.
Great. Thanks, Andreas. Let's give a minute or two for our digital asset folks to come in. Are they here? Okay, so introduce Jacob and Tiffany, who will give us a tee up and an update on the FASB's project on digital asset, or projects, I should say, on different digital assets. Tiffany.
Thanks, Rich. As part of the 2025 agenda consultation, stakeholders commended the board on the issuance of ASU 2308 on the accounting for and disclosure of crypto intangible assets, but many stakeholders provided feedback that there's still several unresolved accounting issues, such as the classification of stablecoins and the transfers of crypto intangible assets. I'll cover the project on the classification of digital assets, and Jacob will cover the project on the accounting for the transfer of crypto assets, including wrap tokens and receipt tokens. At the board meeting in April of this year, the board did decide to issue an exposure draft on the classification of certain digital assets like stablecoins. The board decided to provide illustrative examples to clarify whether certain stablecoins satisfy the definition of a cash equivalent. In making this decision, the board also considered other approaches such as revising the master glossary definition of a cash equivalent or defining a new master glossary term that would apply to digital asset cash equivalents. Ultimately, the board decided that illustrative examples approach would best avoid unintended consequences. The board decided that the proposed examples will illustrate concepts that link to the current cash equivalence definition, such as having an on-demand redemption feature, the stablecoins having a contractual cash redemption right from the issuer, and the issuer maintaining reserves on at least a one-to-one basis in highly liquid short-term investments. The board also decided to clarify that entities should consider compliance with relevant laws and regulations when establishing the accounting policies for cash equivalents. Additionally, the board decided that all entities should disclose significant classes and amounts of cash equivalents. The disclosure will be required annually, subject to the interim disclosure principle in which an entity must disclose information about events since the end of the last annual reporting period that has a material impact on the entity. This approach reflects the board's earlier decision not to define stablecoins when providing the illustrations. For transition, for the illustrative examples, the board decided that the entity should adopt the guidance on a modified prospective basis as of the beginning of the annual reporting period in the year of adoption. And for the transition related to disclosures, an entity would be required to adopt the amendments on a prospective basis. The board also decided that an entity would be allowed to early adopt the guidance. We're planning to issue the exposure draft during the third quarter of this year with a 90-day comment period, and the board will determine the effective date after it considers the stakeholder feedback on the proposed amendments. Jacob will now take us through the transfers project.
Thanks, Tiffany. As you mentioned, the current crypto guidance in subtopic 350-60 was issued in 2023 and covers fair value measurement, presentation, and disclosures for certain crypto assets. However, since then, stakeholders have noted a growing prevalence of economically similar assets, such as wrapped and receipt tokens, that are outside of the current scope and fair value measurement guidance, creating some operational complexity, some inconsistent reporting, and potentially non-decision useful gains and losses. Wrapped or receipt tokens are digital assets that evidence ownership of an entity's crypto assets, and they convey a right to receive back the crypto assets that underlie them. Stakeholders also highlighted the need for clearer derecognition guidance for crypto asset transfers, which is the second part of this project. The board began initial deliberations relating to expanding the scope of subtopic 350-60 in April, and the board will discuss the derecognition guidance in a future board meeting. First, on the scope issue, in its April meeting, the board decided to expand the scope of subtopic 350-60 by revising one of the current scoping characteristics that prohibit assets from conveying rights to other assets to now permit assets that would convey a right to crypto assets that would otherwise be in the scope of subtopic 350-60. In other words, crypto assets like wrapped or receipt tokens that provide the holder with a right to receive crypto assets would likely now also be included within the expanded scope of the standard. This guidance also includes various disclosure requirements, including certain items such as name, cost basis, fair value, and number of units held for each significant crypto asset holding. Stakeholders noted that a potential benefit of expanding the scope of the crypto standard would be that additional crypto assets would be subject to the existing disclosure requirements. Leveraging the current crypto disclosures, the board decided to provide an example disclosure illustrating that wrapped tokens, if significant, would be disclosed separately from other significant crypto asset holdings. Because there's no specific derecognition model for crypto asset transfers, the relevant authoritative gap follows the general intangible asset guidance that leverages the concepts of control from the revenue accounting standard topic in topic 606. However, in practice, some entities apply a variety of guidance, including by analogy to certain non-authoritative sources as well, and stakeholders noted that this diversity has led to inconsistent and sometimes counterintuitive accounting outcomes. At a recent meeting, the board discussed alternatives to clarify how to evaluate whether control of crypto assets in the scope of subtopic 350-60 has been transferred, and to help clarify the derecognition guidance for these assets based on topic 606, because these existing accounting concepts of control are widely used and familiar. This includes evaluating whether some of the current interpretations in that model might benefit from crypto-specific clarification, especially for transactions where the transfer includes a right to take the crypto assets back. That concludes my summary on the transfers project.
Okay. Just a couple things. I think as we went through both these projects, our board members were pretty sensitive to, we didn't want to be responding to every new business model that emerged. And we needed to find a way to deal with it, let's say more tactful, more from a broader principled approach. And so we think, at least so far, that we're hitting that measure. We'll certainly get some feedback on that. But what we have seen is everyone is very excited to come in and talk to you about their unique aspects of their business model. And there's a new business model every day. So maybe just as a little context there for you. Any questions for our staff? Bruce.
Thanks very much. And it's really interesting. I mean, it's an area I've always believed that is important to pick up, and I'm hoping we'll pick it up at some point as well. But I guess one of the things we've always found, when we first spoke about this, was the whole concept of prevalence and saying, look, how prevalent is this becoming? And I think when I looked at what you guys did in cryptos, it made sense, because I think you created that stopgap that said, look, we're kind of generally getting into things. What I was interested in knowing is, as you start getting into wrap tokens and starting to kind of get further and further into these niche products, how much prevalence are you actually seeing in this in the market?
I think we've heard mixed perspectives that a lot of times the perhaps private entities we hear hold a little bit more of these or have more activity or exposure in some of these products than some of the larger public companies. But I think we've heard, as we do outreach, that the asset class is growing, and that those other assets like wrapped and receipt tokens, maybe compared to the native underlying crypto, are growing in prevalence as well. So it's been a bit of a mixed perspective.
Yeah. And Bruce, I guess I would describe it as, if you asked us to identify a dollar population in public companies, some of these issues we might say aren't prevalent by that criteria. But the other thing that we were considering was, if they were going to or continue to emerge or continue to grow at the rate they're growing, did we have some obligation to get in front of them? And I would say probably for the reason that the board added it and has taken action, it's been more along the lines of, we had an obligation to get ahead of them. particularly where we saw there was accounting or reporting that was either not reflective of the economics or that were driving significant costs, or where accounting was actually a barrier to reflecting the economics. And so it's a balance. Patrina.
Thank you, Rich. And by the way, in both of these projects, I think it's really interesting for us to sort of watch what you're doing and learn from it. Maybe I just had a question on stable coins and sort of the definition of cash equivalents. I think there I found it interesting how you're going about that. And I think, Rich, you sort of answered that. You're not sort of picking up a definition of stable coin and saying all stable coins are in. I think you're sort of trying to make your model work over the longer term, no matter what the business model, by focusing on sort of the characteristics of what, what might be appropriate in terms of cash equivalents. Maybe just one thing of interest. I was interested, you talked about, I think that your examples might touch on sort of the amount and composition of the reserve assets. Could you maybe just say a bit more about that? Are you going to describe in some detail what you think the nature of those reserve assets might be?
Yes, thank you for that. Yes, so we will in our examples describe an example that does talk about the reserve assets, and we do link it back to the definition of a cash equivalent, which would say that it's short-term, highly liquid. So things such as money markets or U.S. Treasuries with a 90-day maturity date. So it will link back to that. That will describe that. And also, we are going to explain that it's on a one-to-one basis, meaning that there's $1 in, there's $1 reserves to back it, so that it's highly liquid there as well.
Yeah, and Patrina, we are aware that differences in how stablecoins that are currently in the market today are structured, and how their reserves work and how redemption rights work. Some will qualify and some will not. So that's been pretty clear.
Thank you.
Thank you, Rich. When I saw the project of the FASB in the agenda, not for this meeting, but just in your work plan, we are at the same time working with our project on the statement of cash flows. One thing that we have discussed in our projects was about whether we should review the definition of cash and cash equivalent. And after some discussion, we decided that that's something that we are not start working with. That although we may look at some situations that we heard in relation to cash equivalent and see whether we could try to increase the consistency of the instruments that are considered cash and cash equivalent. When I saw your project, and we are very much interested in where you are going to, the direction you are taking, because we think that it's growing the activities of this type of instruments. And my concern is that the moment that I start taking specific instruments, and I can tell you because of my experience, and you just referred, I think that Tiffany referred to the market fund and other type of instruments. And then I'm just wondering whether there is a growing demand for the market, from the market to every single different instrument that appears. We have to go and see whether it meets the definition of cash equivalent. And then tomorrow there will be a slightly different stablecoin, and then they start coming back and say, does it meet the definition? And we at the IFRS, we are working very much on this principle based, but I was trying to understand where exactly we draw the line when we have to step in and actually try to drive or actually provide guidance to the market, and when actually we should give it the market a go to look at the definition and then determine whether it meets or not the definition of cash and cash equivalent.
Yeah, no, I think that's a good observation. I think it's a challenge that we had when we decided, A, not to change the definition of cash equivalents, and B, we recognized already it was a choice, meaning a policy election on whether you considered non-cash items as cash equivalents, right, when they qualified. Our hope is that the couple examples we gave will be enough to help people understand how to navigate the existing definition. But I would not be surprised for people to come in with their exact example and ask for us to add it. I don't, that's not the approach that we've taken to date, though. But I certainly understand why that would be a concern. You?
Okay, thank you. Thank you, Rich. Actually, I'm very interested in the topic of the stable coin. And I agree with your point that you will not change the definition of cash equivalent. Yeah. And yeah, but based on my observation, I think that the stable coin has its very unique characteristics. I would like to share two characteristics that I think is that struck me a lot for the accounting issue. The first one is the judgment on whether it meets the definition of the assets, because based on my observation that I know some stablecoin issuer operate within robust regulatory frameworks. For example, the entities such as Circle, they are issuing USDC, and the issuer's redemption obligations and the holder's rights are clearly defined. However, I heard that some stable coins are issued in limited regulation and are governed primarily only by so-called white papers rather than legally binding contract. So the main issue here is that the rights and obligation between stablecoin issuer and holders are not always clearly defined, and this is very challenging for the judgment on whether the stablecoin meets the definition of asset or liability. So I was wondering whether you find any such kind of cases. Another point is about, I think just now Petrina and Tadu also mentioned the cash equivalence issue, because based on my observation, in some certain arrangements, redemption mechanism associated with stablecoins may include timing delays or conditional features. This potentially weakening their liquidity characteristics and their ability to be readily converted into no amount of cash. So I think this is also a very challenging point to make judgments on whether it meet the definition and the criteria of the cash equivalence. Yeah, so could you please share a little bit more about how you address this kind of issue? Thank you.
Yeah. So you hope we're familiar with both issues that you discussed, and hopefully we struck the right balance, but we will find out as we get input on our exposure draft. When Tiffany mentioned the reserves had to be held in a certain manner, someone would have to be able to determine that those reserves are held in that certain manner. So those cash equivalents. In the absence of a regulatory environment or something else, that could be very challenging. And without that positive affirmation, could be disqualifying. On the redemption rights, we did spend a lot of time on emphasizing that the redemption right had to be with immediacy, right? We didn't say the exact number of days, but the idea was and that was part of the reason for the cash equivalents backing the asset, was so that there was liquidity there for the immediate redemption, but it also had to be a direct redemption right, meaning not through some other party. So, and what was helpful to us was to look at the money market funds and the requirements around those, and as we look to stable coins and seeing were they similar. We also do benefit, I will say, in the US that there is regulation that has come out regarding the Genius Act. You'll hear it referred to. And also put some constraints on entities and what they would ever consider a cash equivalent. So that there's that dynamic at the same point in time, but we recognize the multinationals will be applying this around the world. Hagit?
Thank you. Sorry for the last minute waking up. I think so. We always assess with those type of project the cost and benefits, and I think your starting point is a bit different than us because you have the option to choose, right, to put something in cash equivalence, which means if it is very difficult task to do what you require here to do, companies can choose not to. Whereas when I translate it to our world, we have a different starting point, and I assume that played a role in your consideration as well, right?
Absolutely. And in fact, I think it plays a role in our existing definition and the ability to work with it.
Thank you.
Bruce?
So just a general question. I mean, are you carrying any calls to do a much bigger project around kind of the whole digital economy with ICOs and all these things happening? Because I mean, you start off with the one, now there's the next one, and this is not something that's going away. It's just getting more and more prevalent. So I just wondered if you've been hearing a call to really kind of spend some and take this on as a major project.
No, I would say no. I would say that I think we benefited that the AICPA had a group that was on top of the digital assets and the accounting for them under our existing standards. So I think that was certainly very helpful. When it comes to the tokenization of other assets, whether it's shares and other items, I think that we may benefit that some of those issues are not that different than other fractional share and other issues. And hopefully people can get through our guidance and answer those questions. So I would say no, we're not. That being said, there is still this desire for some to address their specific business models. And I think that's where we will have an ongoing challenge. Andreas.
So, I mean, this is one of the classic examples where, as a standard setter, you have to take a bet, right? So I think I completely appreciate your point that you want to be ahead of the curve and not come after the event, which I think I have accused all of us as an ecosystem that we are here to solve yesterday's problems, but not really tomorrow's problems. However, every resource allocation decision comes at a price because the resource can only be deployed once, not twice, and there are multiple issues. So the question is really, where do we deploy our resources? As I see it at the moment, and if you look into studies that are being provided by the OECD, by the World Bank, by the IMF, I'm not sure whether that is really a vastly growing market. Certainly in dollar terms, I mean, you actually see contraction. And I think that's one of the big issues that makes it very difficult to opine on it, because the recent studies, and there were news articles just last week, point at the convolution of P times Q. And P oftentimes is the P of Bitcoin. And if Bitcoin really plummets, the entire market plummets, and that by percentage of the entire asset classes just leaves it at a very small fraction. It doesn't mean that is completely negligible, but there may be just one or two different crypto assets that just have huge volatility, and they really define as to, is this prevalent or is this not prevalent? So I wonder how prevalent going forward it will be, and will this ever be a big trend? Now, for us, obviously, this is a very important consideration, because contrary to you, where you say you actually see the evidence that something is happening in a market, and that gives you a justified reason to actually deploy resources in that field, we have to make that assessment on a global basis. And this is one of the classic examples where you see isolated patches in certain jurisdictions where this is relevant, and you see a vast majority of entities or jurisdictions where it is not relevant. And how do you then make a justification and a justified guess as to, okay, is this something where we should be putting resources in?
Yeah, and maybe we're in a fortunate position that we have not had to turn down issues that a majority of our board would like to work on because we were resource constrained. And part of that is we're fortunate where we are and how we're operating. We're also, I think, scoping our projects appropriately so that we can define the problem and tackle the problem, as opposed to more of a broad multi-exposure draft expedition. And that has certainly helped us to more efficiently use our resources so that when the majority of our board is interested in something like digital assets, we can take it on. Bob?
Thanks, Rich.
Sorry.
I was just kind of curious as some of the thinking behind wrap tokens and receipt tokens. We've talked about just in a previous discussion here about the thoughts of not taking on tokenized assets. I read today, banks are developing tokenized deposits, and those really are demand deposits just in a token form. There's real estate, it's just in token form, shares just a token form, and so it's kind of thinking, well, it really doesn't change the accounting just because you tokenize it. Wrapped tokens are kind of that crypto, just again in a different token. It's the crypto and it's just a different token. So I was kind of wondering what you saw, what was being brought to you as the demand of why you needed to address the wrapped and the receipt tokens.
Yeah, and to be fair, Bob, when we did our initial standard setting, that issue of wrap tokens came up, and there were mixed views on our board. The challenge we had at the time was I don't know that we had a clear enough definition of what they were and how they were operating that we were comfortable with doing it at that time. So with the benefit of hindsight, we probably would have done them both at the same time. So since then, we have seen an increase in requests and apparently volume of activities where those are occurring. And given that, that was probably one of the main drivers of why the board addressed it. Okay. Oh, Rika. No problem.
I do think our board's status is whether or not we start thinking about crypto asset and other related matters. We always think when we should support when we should start. So I think other standard setters, we definitely need to think about we need to step in this area, maybe a little bit half step ahead of the world international market status, because otherwise probably we are too late to step in. But at the same time, when thinking about FASB, you have already made a lot of progress in this field that can facilitate our future discussions and our kind of the how we start and where we should focus on. So I truly appreciate today's discussion and exchange point of views on this matter. Thank you so much.
Thank you, Rika. Not seeing any other hands or indicators. Andreas, may I pass it to you for emerging issues and other business?
That may be a very short session anyway, but I may just echo what Rika was saying. I mean, this is a prime example actually where one board does have guidance and the other board doesn't. And this is then obviously always a good opportunity for us to actually piggyback and consider that. Do not reinvent the wheel, start from scratch, but actually take what's there. And ideally, if we are satisfied that we would have come to the very same conclusions, I mean, it would give us a chance to probably take your literature, put a wrap around, issue it for consultation, get feedback, and get it done. I think your starting point in saying you classify this as being an intangible, on many measures being an intangible, is the bit that causes us some grief because our intangibles literature is very old. It's cost based. It isn't really attuned to dealing with cryptos. So I think we've identified that area that something needs to happen. The question is, when is the best starting point to do it and how to do it? But you may hear from us very soon that if we decide to actually move into that area, that there is clearly an interest to just look at the guidance that you already have developed. I'm looking around whether we do have any emerging issues or other items that people would like to bring to attention of the other board members. Something that we haven't discussed today. Rich.
Well, I have something, but I only want to go if everyone else is done. So, okay. Looks like everyone else is done, Andreas. So I do just want to thank the IASB board, the staff for joining us today and spending your Friday late afternoon with us in London. But I'd be remiss if we didn't take a few moments and thank you, Andreas. I've greatly, I think you've been the IASB chair for all but one of my years here at the FASB. I've greatly enjoyed having the opportunity to work with you. I know a lot of times people ask the question about how much do we work together and how much do we share information. And while we may have this annual meeting, we're fortunate enough to speak regularly, that our staff speak regularly. We share information back and forth, and it's quite a bit more than that. So I just, on behalf of the FASB and on behalf of myself, I would like to thank you. You've been a great partner, a great person to work with, a great person to debate issues with. And I look forward to staying in touch with you and benefiting from your thoughts and wisdom, even in your next role. So I wanted to thank you.
Thank you very much. I could just make the very same comment back to you, Rich. For almost all of my time, you have been my sparring partner. The previous role, obviously, I also had the benefit of dealing with other chairs and other board members. I've always enjoyed the proficiency, the openness in many different fora. I think these exchanges, both the annual ones, but also the intermittent one-on-ones that we did have, or the two-on-twos, or whatever you want to call it, actually are very beneficial because they give us early warnings. They give us an opportunity to actually alert to something that's boiling at one end, and that may be relevant for our respective discussions. And I think without that transparency, I couldn't see how we would really serve international markets and investors in global markets, because in the end, both of our missions say we work to the benefit of investors. So I think it is upon us to actually stay as aligned as is possible. And whilst we receive frequent questions as to what's happening to convergence, and just this week we alluded to the securities regulators. They had a question as to how is convergence going? How are you working with the FASB? The answer is always the same. We have a cordial relationship. We share information. We are transparent about that, and that extends over all levels. And I really also, on behalf of my board and myself, I would like to express my gratitude for all your availability over the time and the cordial discussions and conversations that we have had. Thank you very much.
Thank you. And with that, I'd like to conclude today's meeting. Thank you, everyone.